That is the perfect CEO answer, but have you cut costs to the bone?
We've cut them quite a lot. We've had actually a really big cultural shift, which I've driven along with our CFO and our COO president. We've cut headcount in January. We've reduced our real estate footprint. We looked really hard at each of our top 5 vendor spends, and we had to rebuild some of our architecture to use CPU and data storage more efficiently in the cloud. So we have a new kind of moment here around operational efficiency at Coinbase.
Okay, in terms of last year's narrative, it was crypto is the inflation hedge. Now I've got people telling me crypto is my security against an unsafe banking system. Do you buy that? Do you have any demonstrative evidence of flow that as a result of SVB, First Republic, and the other impending moments of angst, that you have a material inflow from that debacle?
So look, I think, Bitcoin is up about 70% year to date. And so a lot of people, they look with 2020 hindsight backwards, and you always have to come up with something.
That's why I want you to cast forward.
Well, look, I'm never going to make a forward-looking projection of what the crypto prices are going to do. I think zooming out, this technology is really important for the world as a way to update the financial system. And the financial system is slow. The traditional financial system, it's slow, it's expensive, there's not equal access for everybody. And so people are looking for alternatives in the wake of these bank failures, and they're thinking more about how crypto can update the financial system. So from that point of view, I'm long, I'm bullish. Coinbase is going to help that transition happen in the world, and whatever is going to happen in any particular quarter or year, that's not for me to say.
We are pegged to the US dollar, the Yankee, the greenback, but is the US dollar coin now de facto the reserve cryptocurrency?
Well, I mean, the US dollar is a
big part of your earnings.
Yeah, the US dollar is still the reserve currency of the world. Obviously, we have a material revenue generation moment with USD coin, and we'd like to create stable coins that, work with other fiat currencies in the world as well. I think it's going to be interesting to see how that evolves over the next 10, 20 years, right? Because we're increasingly living in a multipolar world where the euro and the yuan, and now increasingly maybe Bitcoin or other things could happen over a long enough time frame. But in the short run, I don't think the dollar's reserve currency status is going anywhere.
You're in Dubai. I know you're talking about regulators. We'll talk a little bit more about this later on the podium. But in terms of expansion beyond the US, don't worry, I'll get to Gary Gensler in a moment. Beyond the US, what is your ambition? How big can we be in the UAE in your space?
Well, Coinbase, our mission is to increase economic freedom in the world. So that means we really need to do that in many, many countries. Obviously, we started in the US and took a very compliance-focused approach and became a listed company there, and that's been a big piece of our revenue still. But we've increasingly expanded into other major markets around the world. Now what we're doing is we're looking for a home to set up an international hub that could serve the long tail of countries in the world, the Middle East, Africa, maybe parts of Asia as well. And from that point of view, the UAE is very attractive. I mean, the UAE deserves a ton of credit. They're the first country in the world I'm aware of that created a dedicated new regulator to crypto, and they've published a clear rule book, and it's very business forward and protecting of consumers.
But are they ahead by a country mile here relative to the UK and relative to the US?
Well, I would say they are ahead of where the U.S. is. The EU has actually published comprehensive crypto legislation already. The U.K. is on their way there, but I would say the UAE their approach has been more forward-thinking than the U.S. so far.
So we spoke to your CFO, you're the CEO, the Wells Notice. Everybody, is sort of digging around for news here, and I sat down and thought, what is this Wells Notice? Is it an Armageddon moment, potentially, for Coinbase in the United States of America?
I think this moment is really an opportunity for us to finally get some regulatory clarity in the United States. And we're happy to do that, by the way. I think it's a great role for us to play in the industry and for America.
You're going head-to-head with the SEC.
Well, that's true. I mean, look, we don't relish the opportunity to be in litigation with one of our primary regulators. We've sought out regulation all over the world and tried to be proactive when there wasn't clarity. But if there's no clear rule book in the U.S., we created our own best practices to evaluate, over 1,000 assets, and we rejected 80% of them. The 200 or the 20% that we list, we believe are commodities, and there's been no clear rule book. And so if we receive a Wells Notice, I feel like we have a duty to push back and go seek case law that will help bring this clarity to the U.S.
I mean, I fiddled around with this question for about 2 hours. SEC, CFTC, what is the question you ask the CEO? And here's the question. Are these regulators still fit for purpose?
Well, I think there's certainly a role, yes, because crypto is many things. Crypto has commodities. Crypto has some that are securities. We don't list them, but there are some out there. Yeah. We think there should be a robust, healthy market for that. There's also stable coins, which are more like currencies. There's artwork, with NFTs. And so crypto is going to have a number of different regulators. It probably is going to need new legislation to be passed in the U.S., and the good news is there's broad bipartisan support in Congress for that exactly to happen.
Can you see a day where you go, look, troops out, I'm gone from the U.S.?
We're not going to leave the U.S. We do have a choice of where to invest our dollars around the world in any given moment, but we're not going to leave the U.S. It's an important market, and the good thing about the U.S. is there's rule of law, and so we do reach the right outcome eventually.
Now you've got a new license in Bermuda, and what goes through my mind there is, are you going head-to-head with Coinbase in Bermuda? You can do a lot more and a lot more scale in Bermuda. What is the objective there? Is it to go head-to-head with CZ?
No, so it's international expansion. Bermuda.
That's a very broad term, Brian.
Well, that's true. I mean, we want to have coverage broadly around the world. Bermuda is a great region to sort of serve the Western Hemisphere, if you will, outside of the U.S. But we also are very interested in the UAE to serve this part of the world. I think there's great access to not just the Middle East, but Africa, other parts of Asia. And so the UAE has been very business forward, and we're interested in speaking with people here too.
The institutional side of the business is where I want to get your sense. When we were sitting over there, we were chatting about the ETF, the approval of the ETF. I mean, is that the turnkey moment? Is that the Goldilocks moment for you on the institutional side of the business? What would that mean for you if that gets regulated?
Well, if an ETF were to be approved in crypto, which it probably should be, by the way, that would drive a lot of new capital inflow from institutions. I think that would be very good for the world. For our business in particular, I mean, there's a lot of things that we're doing in the institutional space. We have 25 of the top 100 hedge funds in the world are customers of Coinbase Prime, our prime brokerage for institutions. We also have seen a lot of inflows, and I mean, frankly, we also purchased One River Asset Management, so we now have an asset management business we're developing in the institutional space.
So you got skin in that institutional game. Are you actively now wanting to build out bigger institutional capacity?
Absolutely. I mean, we have an amazing institutional business. I think it's the best in the world in crypto. We're going to keep growing that, but we're also going to grow the retail side.
So this is full boat story. Come on, there's got to be something that causes you to flinch at night.
I mean, I think
the banks. No, you're not bothered about the banks.
A healthy degree of paranoia is always good for every CEO. You always want to be rigorous, but I mean, the bank situation. Actually, I think Coinbase is in a pretty good place here. There certainly was, there was some bank failures in the U.S., and we have about 5 different banks that we were working with in the U.S. 2 of them had issues. We've now kind of reestablished back the level of redundancy that we would like to see in the U.S. But Coinbase, we work with some of the biggest banks in the world, GSIBs, and so I think we're in a healthy place on that. But we need to make sure we're vigilant on that.
Brian, it's always good to have a healthy little bit of bounce in your step. Brian Armstrong, there, the co-founder, the CEO of Coinbase. We're going to go on stage. It's a much gentler ride on stage. Good. Don't worry about that. Brian Armstrong, our guest today from the UAE, to the surveillance team in New York. Good morning.
Hey, Manus, good morning to you. Thank you, buddy. Manus just trying to make sure that his guest doesn't run away. Out of that panel conversation a little bit later.
I've been in the same position, John. You do a chit chat interview, and then you're going to go up on a stage, and you got to do further chit chat. And
hey, sequencing is important. You do the warm fuzzy stuff on stage, and then you slap them around in a proper news conversation afterwards.
He mentioned.
So you thought we were friends? Oh, right,
he mentioned exactly. He mentioned the cost cutting that they're going through. Let's remind ourselves we've enjoyed this stock from 350 down to 58. And, it's trading in I'll call it a range of 50 to 70, 50 to 80 as well. But they're reinventing themselves. And to me, the crux of this, John, is they're basically being kicked out of America. Maybe that's too inflammatory. But Gensler's saying, this is difficult. I'm not sure where this is going.
And Manus asked a delicate question that he didn't want to answer. Elisa, is the regulator fit for purpose? I think a lot of people have an opinion on that at the moment.
Especially whether or not they want to legitimize this asset class. Meanwhile, remember when we were talking about how this asset class was a symptom of the froth that was built up over the past, 10 years, et cetera, and now kind of it's coming back again. It's sort of this muddle that we're in that just continues throughout 2023.
Your latest sport update coming up next with Ian Shepperton at Pantheon Macroeconomics. You just know TK is going to mention something about Newcastle. We'll try and ask him about the Federal Reserve and the recent data as well. On the S&P 500, positive 0.1%. Just a reminder for the calendar for the week ahead. Wednesday CPI, Thursday PPI, a little bit later on this afternoon, the Senior Loan Officer Opinion Survey. Look out for that from the Fed, from New York. This is Bloomberg.
You don't put an Aston Villa.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there's no good alternative to Congress lifting the debt cap. She also told ABC that the use of the 14th Amendment would spark a constitutional crisis. President Biden is scheduled to meet with House Speaker Kevin McCarthy and other congressional leaders tomorrow to discuss the debt ceiling. A new poll shows President Biden's approval rating hitting a career low. It also shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44 to 38. Russia reportedly has at least 300,000 troops inside Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. Germany's Chancellor Olaf Scholz and France's President Emmanuel Macron reportedly plan a charm offensive. According to a German newspaper, the goal is to reset the relationship following criticism that ties have crumbled. Macron is said to be planning a state visit to Germany in July. And in Saudi Arabia, the economy expanded at a slower pace in the first quarter of 2023. That was due to the oil sector, which grew at its lowest rate in more than a year. Saudi GDP rose an annual 3.9% in the first 3 months. That compares with 5.5% in the previous quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is 12 reports in a row that Wall Street has been surprised to the upside. Guys, maybe you should change your model a little bit. That's 12 in a row. That's never happened as far as the chart I saw today. So this is a very tight labor market. It's going to take a while to cool it off. And I think we have to be patient on that dimension.
Jim Bullard of the St. Louis Fed often tunes into Bloomberg Surveillance. This was exactly the conversation we were having with Mike McKee just last week. On the day that payrolls comes out, we've had upside surprise after upside surprise going all the way back to last April for the March payrolls report of 2022. TK, from there on the day the jobs report has come out relative to estimates, we've just had a series of upside surprises which continued through Friday.
To our team working through the weekend, that was a perfect shot to play. What if we get a Bullard Fed? What if we get a market that reacts to a bullard Fed, and that's where the short-term paper begins to go from, say, LIBOR 530, SOFR I think is 5.04, bring them up 50 basis points. That's what Bullard's saying. Make that short-term paper market even tighter.
The reaction and function of this Federal Reserve has shifted somewhat. There is a belief now that the bar for subsequent hikes is now higher than it was maybe a couple of months ago. Lisa, it's going to be more than just about the persistence of the data. You'll need the bank stress to fade over the next couple of months to reintroduce this concept, I think.
Without a doubt. I mean, that's the discrepancy, right, that we're seeing with rate hikes, rate cuts, I should say, priced into the market versus economic data that has surprised to the upside at the fastest pace going back more than a year. If you look at the Bloomberg Economic Index that tracks this. So at what point do we start to see some sort of consensus consolidate around the banking stress either going away or reigning sort of dominant in this narrative?
A June decision is just really tough. You've got the bank stress on top of the debt ceiling mess. On top of the fact that this is basically what you implied in the previous dot plot, which was 5.1% and then pause. At TK, for a June hike, you'd have to believe the bar is pretty high.
And they're going to get... No, I don't. I just need to wait for the data. I'm data dependent. I think the jobs report that we're going to see, I'm looking right now. I'm getting out there. I didn't feed my Bloomberg mouse this weekend. It's not going as fast as it could. Anyways,
what are you after?
Early June. Early June. There's a jobs day. Can you imagine if we get a jobs day like what we got on Friday?
Yeah, I don't think that's sufficient.
Yeah.
I don't think that's sufficient for another hike.
I don't know.
Because of the banking stress.
Precisely.
Exactly to that point, which is the reason why the market ignores whatever they say that could potentially fuel the argument for a rate hike or no rate cuts, and they just focus on what confirms their narrative.
But I'm with you. If you go a few weeks without a failed bang, then the market's going to change its attitude towards the economic data. I mean, we've gone about 1 week. 1 week today. Let's try and go another week. And Tom, then the data takes on more importance.
Yes.
And when you look at the totality of the data, whatever that means, the weight of where the focus should be will shift somewhat away from financial stress and back towards traditional indicators. But I go back to that line from Brett Ryan at Deutsche Bank. We've lost that hike in feeling, or rather they've lost that hike in feeling. That seems to be the conclusion for a lot of people on the street right now around the Federal Reserve.
I think Bullard said it best. They're completely divided. There's a whole group out there. And, you know, I'd really listen to some of the people working very hard to think through stability here or a higher, more persistent rate regime. The key sentence I heard from Mr. Bullard is it's going to take a while, and that's that x-axis moving out. We talked to Randall Krosner about that on Friday. The heart of the matter is, okay, maybe there's a job vector that gets you to rate cuts. Maybe there's this, maybe there's that. But the market wants it, say, middle of July, August description. What if it's October, or dare I say January of next year, where everything is more gradual to get to where the market is?
So here's two quotes for you, Tom, both from Bank of America, one from Mike Gapen, another from Ethan Harris. They work closely with each other. This was from Mike Gapen. I think this contributes to the conversation that you're having, Tom, at the moment. It's difficult to argue the labour market cooled. The report reinforces upside risk to the near-term monetary policy path. A hike in June cannot be ruled out. Mike Gapen on a similar page to you, Tom. This is what Ethan Harris has got to say. There has been only limited progress in bringing global inflation down with almost no real pain, while investors are trying to look towards a more normal period ahead. Ethan goes on to say, first, the rebalancing actually needs to happen. There are some people, Lisa, out there pushing back at the moment.
Well, they're pushing back, and we're not seeing it in the pricing. And what people will say, the reason why you're still seeing rate cuts priced into the market is because people are having these tail risks, right? Either something will happen catastrophic that we can't foresee, and the Fed will be forced to cut by 100 basis points or 200 basis points like that. And other people saying, well, you know, there's a good chance that they're going to have to stay where they are or even hike further. I just keep going back to economic data that keeps surprising to the upside, to inflation that has remained stickier. We saw that employment wage component continue to surprise to the upside in the labor market data. At what point do we end up sort of second guessing, Tom, this idea of whether perhaps we're being a little too flippant about the weakness and the imminent doom that some people talk about all the time? Like
we discuss the dynamics right now. Let's get to it with Ian Shepherdson, Chief Economist, Pantheon Macroeconomics. Ian, how have you adjusted your American economic call over the weekend?
No, I haven't. I mean, the headline payroll number Friday was quite startling, but the revisions were also startling, and they were all to the downside. So stepping back from the noise, look at the trend. Payroll growth has been slowing kind of relentlessly for the last couple of years. We've kind of lost that post-COVID catch-up hiring, which was generating numbers like 600,000 a month, and now the trend is less than 200,000. and it's slowing pretty consistently, and most of the leading indicators suggest it will slow further. And also, just bear in mind, history tells you, if you look at the last few US economic cycles, we go from 200,000 a month and everyone's saying, everything's fine, to, oh, zero, how did that happen? Usually in 3 to 6 months. It tends to happen fairly quickly when the turn comes, and I do think that we're kind of on the verge of that now.
So do you think that right now we are on the verge of an immaculate disinflation, a sort of soft landing that a lot of people are talking about, I believe yourself included, or do you think that there is something more pernicious under the surface, especially with the Fed holding rates where they are?
Yeah, I mean, before SVB went down, I was very much of the dodging the recession and getting inflation down, pretty great scenario story. But I do think that the tightening of credit conditions in the wake of the bank failures is going to be a very big deal. Small businesses are already squawking about it. The NFIB, the Small Business Survey, is at recession levels already, and it was there before the banking crisis. And so I'm very nervous about what it's going to show in the next couple of months in terms of credit conditions. And, small companies employ more than half the workforce. They do an awful lot of capital spending. They carry a lot of inventory, and all those things are going to become much more difficult, much more expensive for them. So I can see a real kind of bifurcation now where the large corporate sector does okay, but the small business sector, which is kind of hidden from view most of the time, is really going to struggle in the wake of this bank tightening because they're just captives of their banks, effectively, most small companies, and it's going to be a much more difficult environment. So now, unfortunately, I think a mild recession is the most likely outcome.
Do you think that we're overestimating or underestimating the role that small banks play in the U.S. economy?
Oh, I think it's almost impossible to overestimate because they account for well over half of all the lending to commercial real estate. They account for about half of all the lending to commercial industrial companies. And for a lot of small businesses, very small companies in particular, they're just captives of the bank. The bank is the only source of external finance apart from the owner's pocket. When banks are raising credit standards, they're raising spreads, they're raising credit scores, they're making it more difficult to get asset finance, more difficult to get working capital. It has a very profound impact on the ability of the small business sector to continue to operate. So, of course, we get very little data. Most of the data we get is whole economy numbers or big company surveys or big company data that we get through earnings reports and all the rest of it. But if you really look below the hood at what's going on in the small business sector, there's some very alarming trends there already. Their capital spending intentions are rolling over. Their own perceptions of credit tightness jumped dramatically in the wake of SVB going down. And we get more information on that tomorrow. It's not going to be good. And it's very easy to kind of ignore them because it's so much easier to focus on the large corporate sector. But most people work for small companies.
Ian, big question. It's all we want to know from you. Were you at the game this weekend?
I wasn't, no. Just good for my nerves.
They lost, Tom.
I saw
to
it.
Arsenal.
I watched.
I saw that too.
I say, what I don't understand is that Newcastle's the only place where they all take their tops off.
Doesn't matter what the weather is.
It doesn't matter what the weather is.
Cold.
Can you just see Shepherdson there? I can see him,
Ian's a hooligan.
It was very warm yesterday.
40 degrees, 5 rows up. Shepherdson's 5 rows up naked by the
Ian's a
half.
hooligan. Ian Shepherdson of Pantheon Macroeconomics. Ian, thank you. I can tell you a story. I think I've told you this before. Boxing Day, day after Christmas. It was Newcastle West Brom. That's a team in the Midlands. Freezing cold, absolutely freezing cold. Newcastle fans behind the goal at the one end. Tops off. Just seriously, they are some of the toughest fans out there. Yeah. And they turn out in force for every single game. It's so impressive.
The experts on NBC, thank you for your great coverage. I hate when it's on Peacock, but not to get into that sidetrack. But, John, what I find interesting here is it right that big money took over Newcastle?
Some Saudi money.
They're ahead of schedule.
They're being responsible. Yeah. They're not throwing it around in the way that maybe Chelsea did 20 years ago, Manchester City over the last decade. They've been responsible about that so far. Not to get stuck in something we shouldn't be talking about.
Somebody emails.
God forbid.
Somebody emails in.
No, we never do
Somebody emails in and says, how much beer are they drinking at Newcastle to stay warm?
A fair bit of ale, Tom. David Leibovitz at JP Morgan up next.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're very far away from what these job market reports need to start to look like.
We keep printing lots of jobs. People have got jobs, they got money, they go out and they spend.
We just think that this market remains fragile and vulnerable, and we're looking for another 5% or so pullback from here.
The U.S. is settling down while the world is holding up a bit.
12 months from now, we think the Fed is aggressively cutting rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive 0.1%. Another big week ahead. TK CPI just around the corner a little bit later on this afternoon. A bank lending survey which has been much anticipated for weeks now as the banks run into some more difficulties over the last couple of weeks.
I agree with your take that this afternoon really matters, but I've got to be focused on inflation. What I'm hearing off of the shock of Friday's jobs report, everybody starting with Governor Krosner on Fridays moving out their x-axis. We heard it from Bullard in the last hour as he talked to the Minnesota people. And the bottom line here, John, is that inflation report, it's been underplayed in all the bank exhaustion we have. Guess what? Wednesday matters.
Are you suggesting it won't be too long before we're talking about hikes again in June?
I am suggesting that the rate cut mantra is in full swing, and boy, was there a pause at 8:30 on Friday.
The data's pushed back against that. Stuart Kaiser of Citi had this to say over the weekend. Markets were risk-off for the week, but we are very surprised by the rally on payrolls. Lisa, investors seem happier about not bad growth data than concerned about hawkish wages.
I would agree with that. And that was a surprising response to economic data that was better than expected, because we have seen over the past few months, people then were worried about rate hikes, further rate hikes, the Fed going further. The Fed doesn't seem to be back on the table in any way. People basically saying, well, the banking stress will take care of that. And good news is good news. So at what point do we get the Fed come back into play? Or is this the new reality that basically we're going to have rates stay where they are for a prolonged period of time and the economy will continue to surprise to the upside?
Have we taken care of the bank stress? $10 name, PacWest, last Monday, dropped hard through the week. Right now in the pre-market, $7.60, Tom.
As a general rule on a single, below $10 stock, the media loves to focus singularly on percent change. And I just think it's got to be more sophisticated than that. And the answer is, I don't know if you've got this chart in the control room, Talia, bring it up if you can. She crafted this brilliant chart which shows the resistance, John, that they've got to get through here going 7, 8, 9, 10 and such. They're nowhere near breaking through the resistance of the last 7 days or so. On radio, it's simple. It's 1 price decline, 2 price declines, 3 price declines. Yeah, Friday pop-up.
We had this experience, Tom, in the Eurozone in the debt crisis. You had the Greek banking names.
Yes.
They became so low in price, you just stopped quoting percentage change.
Yeah, well, that's what adults do. They don't quote percentage change, but the answer is that feeds the emotion that sells newspapers.
You know what adults do? They quote Dow points, Bramo. Don't forget it.
Thanks, I appreciate it.
Hey, 3M may leave Minnesota manufacturing and mining. They're talking about it may leave the Dow.
Wow.
Which would be...
Pushed or jumped?
Pushed would be it. A lot like John Anaconda Copper a few years ago.
Yeah, good story, that.
We're crushing it.
Let's go straight to the market. Equity futures on the S&P 500 up by 0.16%. Yields are higher by a couple of basis points. Lisa, 346.16 on a 10-year.
Today, we're fully trained on 2 p.m. That is when the Senior Loan Officer Opinion Survey from the Federal Reserve will be released. And then people will come up with the reasons not to care about it. I will just say, pre-market trading, PacWest shares surging 32% and Comerica shares surging 7%. Look, they're still pretty deeply depressed, to Tom and John's point, but we are seeing a little bit of a rebound this morning as people try to gain some optimism around that sector. Tuesday, tomorrow, U.S. President Joe Biden is meeting with congressional leadership, Mitch McConnell, as well as Kevin McCarthy. Debt ceiling. Why are we not talking more about it? It seems like it's a problem.
This is big meetings tomorrow.
This is, yes, and this is a really important meeting. How much consensus can they come to, especially if Janet Yellen is correct and we run out of money on June 1st? And then on Wednesday, we do get CPI, followed by PPI on Thursday. Do we care if it's an upside surprise? With the wage data, we got an upside surprise in the data on Friday, and people didn't seem to care that much, maybe a little on the margins, but it really hasn't shaken the underpinnings of the market the way that I expected.
It's not Europe, but they care. I'm sorry. I know we've gone from 8, 9% down to 5%. That's not like Germany. It's not like the United Kingdom, but still, these rates are totally unacceptable. They care about the dynamics.
With us around the table, David Leibovitz, the global market strategist at JP Morgan Asset Management. David, good morning to you.
Morning.
How long before we're talking about a June hike again?
So it's interesting, and the point that I think you all were discussing prior to the break, I think is really what investors need to focus on, which is everybody's expecting that the Fed is done. Everybody's expecting that the Fed is going to start cutting rates at some point in the back half of this year. If you think about where the risk lies relative to that view, it very much lies to the upside, right? So the risk here is that people find themselves flat-footed. I would agree with you on the inflation point. The rate of inflation is entirely too high. Not to mention Powell's favorite indicator continues to trend higher, right, which nobody's really talking about. And so, is the Fed going to do 4, 5, 6 more 25 basis point hikes? Probably not. But if you're thinking about a portfolio and you're thinking about what could give the market jitters going forward, I think it very much lies in that upside risk around the Fed doing more than the market expects. That could even be staying on hold, given the way futures are priced today. But again, very much view the risk as being to the upside.
Equity leadership, where does it come from, if that's your backdrop?
So I think, the interesting thing that we've spent a lot of time talking to clients about is, back in March when we started to see stress in the banking system, why aren't equities going down? And the answer was the 10-year fell 50 basis points, and that boosted all of the tech names, and that allowed the S&P 500 to keep its head above water. I don't think you're going to see the market broadly, do particularly well in that environment because the big heavyweights in the market are just too sensitive to the overall movement of rates. And so I think what you end up seeing is kind of a nowhere market, right, where the average stock arguably starts doing a little bit better, maybe some utilities, healthcare, staples, but tech's not going to lead us out of this hole if the risk to rates is to the upside.
I want you to talk about this because you're going into institutional and high net worth people and they're scared. You know what? The bottom line here is the rest of the market is witnessed by the SPX has come out of a brutal bear market in October and it's made back a huge part of that loss. I think that's underplayed by people addicted to covering Apple every 15 minutes, breathless. Do you look at this as the bottom of a market in October and we're climbing out of it into a positive return for everything else besides Apple?
So I think at the end of the day, the problem with saying that October was the low is it reminds me of people telling me that June was the low, right, in the middle of last year. And we had priced in a recession because the median decline, excuse me, is 25% peak to trough. And we did that, right? So we must have priced it in. But let's talk about the growth data. Let's talk about the jobs report. I mean, this is not an economy that is anywhere close to being in recession, in our view, when you look across the board. I don't think we necessarily set a new low, but we could arguably retest those existing lows at some time before the end of the year.
So is good news again?
I think good news right now, it's an interesting question because the market has shifted its focus away from inflation and back to growth. And on the one hand, that's allowed the negative correlation between stocks and bonds to take hold again. And so market performance this year has very much been better. But I worry that if the inflation data doesn't cool off, then good news becomes bad news because it means that the Fed is going to have to do more. So we're in this kind of weird nebulous state today where it just doesn't seem to us like investors broadly are accurately pricing in the risks around monetary policy that we see on the horizon.
If there is another bank failure or another bank jitter that emerges, does the data matter about inflation, or do people basically discount the Fed no matter what?
So I think that's the problem, and that's what's happening today, is that people are saying, look what's going on in the banking space. It looks and feels and smells like something we may have seen before. The Fed's going to have to go on hold. But, again, I would make the point that banks fail every single year. Right? It's just not usually the 16th largest bank by assets. And that's what really caught people's attention. And so, I think we could see continued stress in the banking system broadly, but very much at the lower end as we work through some of these COVID excesses and we work through the duration mismatch that we know exists today. I'm not sure that we're out of the woods, but I do think that the big booms have probably been heard.
I don't want to get in trouble with Mr. Diamond. He hangs on your every word. But the bottom line is, are we going to see a banking roll-up in this country? Keep J.P. Morgan out of it. Are we going to see a banking roll-up in this country?
Well, I think what's interesting that really ties back to the structure of the U.S. banking system, right, which is much more fragmented than what you see in other parts of the world. And so arguably that caters more to M&A activity than would be the case in some place like Europe. I think it would be premature to say that we've seen the end of consolidation in banking.
He read, that's like when Powell's in his press conference reading off the piece of paper. David did that. He absolutely nailed that.
I'm pleased you mentioned the bank failures and how much more regular they are relative to how much they get talked about. The FDIC has got a nice little table. You can access it easily on Google. I just did. 2017, 8 banks in America failed. I don't remember talking about it in 2017. 2024 went under. 2019, 4 went under. There's a reason, and you've pointed it out. They're that much bigger this time around. And there seems to be a feeling that perhaps that can bleed into and towards a credit crunch more broadly. Do you have those fears that we do get that credit crunch ultimately, and that's why you shouldn't be pricing in higher rates off the back of this robust data, because ultimately the banks are going to take care of business?
So I think that you do get a further tightening in credit conditions, but I think the mistake that people are making is they hear the word bank and they think 2008. And structurally, this is a very different issue than what we were dealing with 15 years ago. And so could the market, right, we're back to the market doing the Fed's job for them, could the market do some additional tightening, and maybe that means the Fed doesn't need to continue hiking rates? Absolutely. I wouldn't be surprised to see that occur. You're actually already seeing, right, in some of the more cyclical parts of the economy, things like manufacturing, cracks begin to form. But is the banking situation in general going to, get the Fed to do a complete about face? I think that that's a bit of a risk. I think if anything, it speeds up any potential rate cuts later on this year. But I still think summertime for easy monetary policy may be a little bit premature.
David, appreciate it. Thank you, buddy. David Leibovitz there of JP Morgan Asset Management. Coming up a little bit later in the program in the next hour, Rob Waldner of Investo. In about 5 or 10 minutes, we'll catch up with AMH down in Washington, D.C. Anne-Marie's thoughts coming up on this poll right here from the Washington Post ABC News poll over the weekend. The percentage of those approving of Biden's performance has fallen to 36%.
Got to address it.
6 points lower than in February, a point off his previous low in early 22.
Yeah, back to early 22, but my basic answer is anytime you have a president under 40%, you got to be talking about it. I mean, that's stunning.
For a long time, we talked about him having an edge over former President Donald Trump. Bramo, not in this poll.
Which raises some questions. What happens if he starts to lose against him? Who do they have in the wings?
Are they even going to have a contest? Never mind who they've got in the wings.
But that's my issue, right? If there is no other front runner, what do they do with that?
Anne-Marie coming up in about 5 minutes. Look out for that conversation just around the corner. Equity futures on the S&P 500 positive by 0.2%. Getting your week started here in New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there are no good options for solving the debt limit stalemate other than Congress lifting the cap. Yellen told ABC that the White House resorting to the 14th Amendment would provoke a constitutional crisis. President Biden discusses the matter with congressional leaders on Tuesday. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. The 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest that was jammed with ammunition. Japanese Prime Minister Fumio Kishida has visited a landmark visit to South Korea. Now, he met with President Yoon Suk-yeol and pledged to seek cooperation on high-tech goods. Kishida said the trip helped, quote, deepen the relationship of trust. The visit marked the first formal summit in Seoul between the neighbors in a dozen years. It's a holiday in the UK following the weekend coronation of King Charles III. The crowning ended Charles's 7-decade wait for the throne, and it marked a turning point for the UK and the monarchy as he tries to adapt to the current era of technological and social change. The king told a packed Westminster Abbey that he had come, quote, not to be served, but to serve. And President Biden will announce that the government is drafting new rules for airline benefits for stranded passengers. Carriers could be required to provide meals, hotels, and additional compensation due to canceled or severely delayed flights. Authorities say they expect air travel this summer to surpass pre-pandemic levels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
To keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
There is no way to protect our financial system and our economy other than Congress doing its job and raising the debt ceiling and enabling us to pay our bills. And we should not get to the point where we need to consider whether the president can go on issuing debt. This would be a constitutional crisis.
That was Janet Yellen, the U.S. Treasury Secretary, speaking on ABC over the weekend. Congress has a job. Her message, to get it done. We'll get to that in just a moment. From New York City this morning, good morning. On TV and radio, here's the price action for you on the S&P 500, positive by 0.2% to build on the gains from Friday, and decent gains they were off the back of a strong payrolls report relative to expectations, pushing two-year yields a little bit higher. The follow-through this morning, positive on futures, yields a little bit higher on a 10-year by a couple of basis points, 346.35. The euro did absolutely nothing through the whole of last week, 110.49 on the euro against the dollar right now, positive by 0.3%. The poll that we've been talking about, though, here are the details from the Washington Post ABC News poll released over the weekend, showing the president lagging Trump in early voter preferences. The percentage of those approving of Biden's performance has fallen to 36%, 6 points lower than in February, and a point off his previous low in early 2022. And let's address the elephant in the room, because this poll did. 56% disapproved of his performance, 68% regarded Biden at 80 as too old for another term. On the question of whom voters prefer for 2024, only 44% viewed Trump 76 as too advanced in years.
Yeah.
Participants also rated Trump's physical health and mental acuity as higher. Tom, what's amazing to me is that we're having these conversations out loud going into this race.
I agree with you on the out loud, but it's also the original moment we have of a former president, I believe 78, and a present president 80, and everybody can do the high-end calculus to get out 4 years from 2024. Anne-Marie Horton has done the math. She's our Bloomberg geriatric correspondent this morning. Anne-Marie, look, I'm going to cut to the chase here for our international audience. You, I, John, and Lisa witnessed the president at the White House Correspondents' Dinner. It's clearly within the zeitgeist, and the answer is 68% worried of his age, and I believe for the former president, it's only 44%. What does the White House do this morning?
Well, I think what they do is what he did at the White House Correspondents' Dinner, which is making sure that he is active, he's in front of the public, and he's on cameras giving speeches. He just gave an interview Friday very late in the evening with MSNBC. He's going to be having an event today at the White House, and I think this is a way they can try to combat the fact that people think he's too old for the job. If he steps up and does the job every single day, that's one way they can see potentially changing some of the public opinion polls. You know, the president, though, does have a sense of humor. He joked about his age at the White House Correspondents' Dinner. He says, you know, they say I'm too old. I say, listen, I'm wise. He feels that he is fit for this job. He is currently doing his job, doing the travels, everything that is needed. But obviously, many people are concerned, given the fact that he is the oldest president in history. He would be 86 at the end of that term if he were to win in 2024.
Is there a mood of a reshuffle at the White House? Is it the idea of getting in fresh bodies to support a president on that election charge?
Well, obviously, the campaign will have fresh minds and individuals. Inside the White House, we have recently seen a number of changes with the chief of staff, with the head of the National Economic Council. But I think that is less about Biden and re-election and more about just the cyclical pattern of an administration, right? People do tend to move on after a year or two and go do something else because these jobs are incredibly time-consuming and taxing. But there is some interesting fresh faces at the White House. He's also bringing some people that he trusts closer involved inside the White House as he looks to finish off these next 2 years. And he becomes a candidate for 2024.
One of those people potentially is Kamala Harris, and she was on stage with him at the White House Correspondents' Dinner, the first time that a sitting vice president has been on that stage with the president going back to 2016. Is that important in terms of the messaging going forward for this election and her role that she'll be playing?
I think so. I think they want to make sure that the vice president is out there on the cameras the same way you see the president. Also, the president spoke about her in his interview with MSNBC, saying that she's done a fantastic job. I think many people in the White House think that she is underrated with the public. She has not polled well either. Potentially, though, she has been leaning into the issue of women's health and abortion. That was a huge issue for the midterm elections, is going to be a big issue for 2024. And they think that she is the right voice to talk about that. And potentially, this could help their campaign.
Is anybody happy about a redux of the prior election of Trump versus Biden?
I don't know. I'm looking at these poll numbers. I don't see many people that are happy about, I'm not going to, speak for all of American people, but the 1,000 individuals that were surveyed on this poll doesn't look too happy that these are the two candidates they want representing either party.
They're still close to 18 months, right? It's still a long way away. Let's see if this is the outcome.
I know for you, John, in the UK, this timeline is just feels like forever, doesn't it?
But MH, we can play with it. Let's imagine this is the face-off. Round two, so to speak. The nature of this president's campaign has got to be so different to the nature of the campaign that he conducted through the depths of the pandemic and beyond, where effectively he could hide and make it a referendum on President Donald Trump. Anne-Marie, you'd imagine he can't do that this time around.
No, one, he cannot hide, and he's not, but he's going to be out and about doing what he needs to do as president, and he's going to have to obviously pick up some more events. I know he's going to New York as well this week. He's going to have to be meeting with donors, going to have to be meeting with the Democratic Party on top of the normal, everyday items, meetings that the President of the United States has to have, including the foreign travel. Second, it's not a referendum on the former president. They'd like it to be, but it will be a referendum on the current administration. It makes it much more difficult.
Before you run, can I just squeeze this in? Can you give us the timeline for the next week or so? There's a meeting tomorrow between congressional leaders and the president. What should you be looking for? What should we be looking for in the next 24 hours, 48 hours?
Tomorrow's a huge meeting. I think what really matters is when they walk outside and they go to the cameras on the North Lawn, what do congressional leaders say? Most notably, Speaker McCarthy. Does he come out and say, there's a path forward for this? Or do the battle lines, do the red lines, do they get hardened after tomorrow's meeting? It really is a critical meeting because that timeline is getting shorter and shorter. We are less than a month away from what the Treasury says is the X date.
Looking forward to your coverage, Anne-Marie. Tremendous as always. Anne-Marie Horden down in Washington, D.C., our chief Washington correspondent on the latest. Let's talk about it. You talked about being exhausted, Lisa. Never mind being exhausted. So many people are frustrated with this topic, particularly on Wall Street. They can't find an edge. They've got no read on what's going to happen. It's one of those things, Tom, that's important to markets, but you don't really know what to do with it in anticipation of it, apart from the at-risk maturities in the T-bill market. It's like, what do I do with this?
The heritage of this is certitude. It's no big deal, except there was, I believe it was 2011. Oops. And all of a sudden, on an afternoon, I remember it. I was out. I was gone. I was, in my, shorts and T-shirt and bow tie, and they said, you got to come back into the studios. That's how bad it was. 2011.
You can't tell a story that starts like that. Shorts, T-shirt, and a bow tie.
Bow tie. It's like I'm walking around Central Park with Vet Bill, and they said, you got to come back to the office immediately.
So he did it with the cigar?
I brought the cigar in, and they got angry. But the answer is 2011 surprised everybody. It's like, oops.
As a base case, Tom, can we conclude that this will lead to spending cuts and ultimately should contribute towards slower growth?
I don't buy that. I think it's an arch debate over the conservative, almost religiosity of spending cuts versus tweaking the growth of spending. Those are two widely different things. Lisa's much more up to this than I am.
Well, no, it's a frustrating debate for everybody because it's got no positive side to this. There's no positive to have this hashed out in this kind of forced, contrived manner that puts the U.S. credit rating at risk. And what this shows is a complete inability to get things done, and frankly, a lack of vision when we're talking about what can you herald, et cetera. We are in a muddle, but where is the vision to try to put something forward?
There isn't a vision.
It's frustrating.
The core conservative ethos here is it's a huge positive because their core constituency really cares about this, and they want less government. That's all there is to it, as Ronald Reagan, would mispronounce in America. That's what they want. That's all there is to it. And they're speaking to their core constituency.
It's religion until you get in power, and then it's like
and
separation between
this
church
goes
and state.
back
I don't believe in that
to
anymore.
the mythology that we remember from Ronald Reagan.
Well.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
If you ever tune in on the weekend for Premier League football at the start when the players are lining up, I don't know if they're playing a song when that happens, Tom.
We do that. The kids come in,
But
we
they
walk
cut
in
to
with the kids.
they cut to the betting gods on one side of the screen.
Yeah.
And and then you see the players shaking hands, and you get a vibe. You pick up on the vibe of the game, and it's sticky. You don't turn the channel. It's sticky. We need that for Bramo in commercial breaks. After that debt ceiling conversation, Lisa, you wouldn't even need the volume up. You wouldn't need the volume up.
No.
It's just frustrating.
She looked like she was landing a plane at JFK.
It's frustrating because it's just a disingenuous conversation. When Trump was in office, he raised the debt ceiling. There was no problem with it. Nobody had an issue with spending. And all of a sudden now we have this massive issue and we're possibly going to default. And oh my goodness, everyone's going to put their pet project in there and then we're going to bring us to the brink and no one knows what to do with this. And it's annoying because it doesn't have to be this way.
Politics, it works for both sides, doesn't it?
Always, but it's just frustrating. Ugh,
Okay.
I'm done.
All right, you take a breath. That was good. That was fun. That works.
Was it?
No. The equity market on the S&P 500. Last week, losses Monday, Tuesday, Wednesday, Thursday, gains on Friday. The gains on Friday off the back of a robust payrolls report, we add to them just a little bit, up by 0.2% on the S&P. The Nasdaq totally unchanged. In the bond market, 2-year, 10-year, 30-year, looks a little something like this. The 2-year still sub 4%, but getting there, getting closer to that 4 handle. We're up by 5 basis points on a 2-year, 396.58. You know all about the data for the week ahead. If you are just tuning in, welcome. Here is your data for the week ahead. CPI Wednesday, PPI on Thursday, Senior Loan Officer Opinion Survey comes a little bit later on this afternoon.
Right?
2 p.m. Eastern Time. Big deal because we've been talking about it for weeks, Tom. I think Bramo said May 8th at the end of March. That's what we've been waiting for, right? May 8th.
Then it's going to come out and people are going to be like, oh, it doesn't really matter. Because
Well,
it doesn't really
Chairman
track the actual data.
At least you'd have to think Chairman Powell had a read on that already in the news conference last Wednesday, surely.
And he said basically it showed what we already expected. And this is just gradual credit tightening from the rate hikes, not necessarily some sort of fissure in the market. We're also looking at some of these single names. There have been a number of earnings that have been coming out throughout this week, throughout this morning, including Tyson Foods, which this actually is telling. This tells you something about the economy. Those shares down 8.3% in pre-market trading, cutting its outlook for meat sales this year. Consumers are switching to cheaper foods as a result of inflation. So in order to say, okay, consumers can absorb higher costs, can they? Which items can they not? Which items do not have pricing power? Dish Network is down about 1.7% after missing estimates for earnings sales and showing subscriber losses. They also talk about a hack that made things a little bit more expensive and difficult. And I wonder how much cybersecurity is going to continue to play in this. And PacWest shares, Tom, surging 39%.
There you go, the percent move.
No,
Up to 8. I haven't done, I'll do the math here to be responsible to our audiences in radio and TV. I'll do the resistance math here right now. I haven't done it yet.
But to me, I wonder, have we seen the worst of it? Is this a recovery enough, just stability, to sort of have people move on? Or is this persistent feeling that something has changed? And it seems like that's what's still baked into the market.
I thought we'd found some stability about a month ago, so.
What do you know?
And then it hit the fan again. So I think we have to work through what we've described a million times as a process and not a one-off event. And Tom, you're going to have bumps along the way through that process.
What I mostly saw this weekend, guys, is a lack of research. It's a really important time to talk to Subrata Rajappa, head of U.S. rate strategy at SocGen, over the silence over the weekend off a shocking jobs report and maybe a reset of what interest rates will do as the thermometer of the system. Subrata, did you adjust? If I say to you, where's the 10-year yield 12 months out? Is this an adjustable number or is it one big SocGen guess?
No, I think we've kept our forecast relatively stable. We've seen sort of this up and down motion in the data week after week. On the one side you have the regional banking crisis, on the other side you have strong fundamentals. But if you look at the bond market, broadly speaking, from early March to now, really nothing has moved much. The 2-year has stayed around 4%, broadly speaking. The 10-year has stayed between 340 and 360. And the 2-10 curve has been anywhere around negative 55, negative 50 basis points. So it's been a lot of movement, but within a very, very narrow range because the market really lacks clear conviction on where we go from here. But that said, I think that risks continue to be skewed to the downside for yields. If we do get strong data, the market's going to dismiss it. If we do get weak data, I think you're going to see a little bit more of an outsized move lower in yields.
You went right where I want to go, Subrata. If I look at the Bloomberg Total Return Aggregate All-In Index, it's a price index, folks, and it's basically a straight line of, think Bill Gross, Mohamed El-Arian's success at PIMCO for 15 years. And then, as you know, Subrata, down 17% in the mother of all-in bond bear markets. And yes, there's been a bounce, but we don't talk about it like we talk about stock bounces. Are we bouncing off a bond bear market to something constructive?
Yeah, it certainly seems that way. Yields do seem like they peaked around 4% and 10s the fourth quarter of last year, and the trajectory seems to be towards lower yields. I think that this time around, the key difference is that we might, Fed funds rate, nobody's expecting Fed funds rate to get back to the zero lower bound. And the decline in yields from here on is going to be much more modest and gradual. Even in our own forecast, we have 10-year yields only getting to 3.25% by the end of the year. Why? Because of the fact that you have global bond yields continuing to rise. The ECB is poised to hike more. The Bank of Japan could widen its YCC band at the June meeting. So in this sort of context, and inflation is also high and sticky, it's going to be very hard for a meaningful decline in yields from here on as well. So it's going to be one of those situations where yields remain range bound. We get perhaps very weak data. We price down to a lower range, but we're not going to go back to the zero lower bound in Fed funds. And 10-year yield decline is going to be a lot more gradual in that context.
Subhadra, what do people do when there's kind of this tight trading range and you don't really expect it to break out? I mean, do they basically just clock in for an hour, making sure nothing changes, and then go take a break? I'm serious. I'm just wondering how sort of sleepy things are out there as people realize that there is no conviction and there's very little visibility to get an edge on one side or another.
Well, you can trade the volatility within the range because you've seen pretty sharp moves in gamma, so you probably want to be long gamma in the volatility market and maybe pick up some returns there. But you're absolutely right. There are no larger directional moves to play in this market, given the fact that yields have been range bound, and people are positioning for the next leg lower in yields because that seems to be the broader directionality given tightening credit conditions. I mean, we know that policy works with long and variable lags, and the employment picture is going to remain relatively strong until the bottom falls off. So you're kind of positioning, if you will, for that sort of scenario where you see a meaningful slowdown in the second half, then you could see that next leg lower in yields. But again, as you were speaking earlier in your program, I think that the market is underpricing the risk of the Fed remaining on hold for the remainder of the year. We're pricing in cuts for the second half of the year. If we can get past the regional banking crisis, I don't see any reason for the Fed to jump into cutting rates in the second half.
What would it take to not be past the regional banking crisis? I mean, at a certain point, people are pricing in that it will persist. When do we signal the all clear?
That's a very, very difficult, question to answer because you're looking at an economy of haves and have-nots. The larger banks are doing, quite well. The smaller banks and the small business areas, if you will, are coming under a lot of pressure because of their dependencies to regional banks. So this sort of bifurcation is going to really muddy the picture. And in some respects, even though the Fed continues to say that the financial stability concerns, they have tools to deal with that, they have tools to deal with inflation, these two opposing factors are going to make it very, very difficult for the Fed to really adjust policy in a meaningful way. They can't cut rates for financial stability and they can't hike rates for inflation. So that's when policy gets very tricky. They're probably going to be on hold for the remainder of the year.
So Badger, never mind the Fed, we've got to talk about the ECB. Eric Nielsen, UniCredit, fantastic note over the weekend, said this: my fear is that as the lagged effects of the monetary policy tightening now begin to hit the economies, the European underperformance will be longer, deeper than needed because of excessive monetary tightening. So Badger, industrial production in Germany this morning, downside surprise. Factory orders last week, ugly. Earnings from Maersk don't really scream that trade is good right now. So Badger, do you think there's a real risk here that perhaps the ECB relative to the Fed is the central bank most at risk of making a policy mistake at the moment?
But that is always a problem when you're following the Fed and not leading the Fed in an inflationary environment or in a hiking environment, broadly speaking. This almost always happens in every cycle where the ECB, overshoots or delivers more hikes because they're singularly focused on inflation, but not broader economic fundamentals, and then they have to play catch up on the downside to the U.S. I mean, broadly speaking, if anything, coming into this year, I think a lot of people are expecting the European economy to go into a recession. The European economies and UK even has done a lot better than people had broadly expected. That said, a slowdown is to be expected given how aggressively the ECB has hiked rates. So, the trajectory, I think, ultimately will be that the Fed will have to pivot and the ECB will have to pivot shortly thereafter.
Subhadra, wonderful to get your perspective, as always. Subhadra Ajappa there of SocGen on the latest on the Fed and the ECB. That note from Eric Nielsen over the weekend, Lisa, great read. The risk that the ECB is going to excessively deliver excessive monetary tightening relative to the data that we're starting to see in spots. I don't want to overdo it here, but in spots over the last week show some weakness.
I feel like this is the same conversation we were having 6 months ago for the Fed, right? That basically they were overdoing it and they were raising rates too far at a time when there were signs of weakness. And those signs of weakness never really materialized in the way that a lot of people thought. So it's a very difficult moment because if you do believe that Europe is tracking the U.S. on a lag, well, this is exactly the narrative in the U.S. about 6 months ago.
I think it's one of the most misunderstood things. If you take the animal spirit, the nominal GDP of the United States of America, and you go back, John, to the financial crisis, guess what? Before that, Eurozone was really advancing nicely. There was a real log slope. It ended in 2008. Is it eurosclerosis? It's not for me to say. We'll listen to our guests on that. But I'm sorry, they are radically two different trend lines.
Perhaps, and we don't know yet whether this is really the start of something new. One thing that's notable is that the dollar has underperformed in light of the small banks and what's going on there. And that's like one of the distinguishing features right now between the U.S. and Europe.
The Eurozone bank lending survey last week was pretty ugly.
It was.
I'd say, yeah. And they still hiked interest rates and signaled they'd go again at the ECB, Tom.
John, 110.47.
I know. It's a total snooze. It really just hasn't done much. 110.46 right now from New York City. Taking the rest of the week off. I'm Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there's no good alternative to Congress lifting the debt cap. She also told ABC that the use of the 14th Amendment would spark a constitutional crisis. President Biden is scheduled to meet with House Speaker Kevin McCarthy and other congressional leaders tomorrow to discuss the debt ceiling. A new poll shows President Biden's approval rating hitting a career low. It shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44-38. Russia reportedly has at least 300,000 troops inside of Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. In Germany, industrial production fell by the most in a year. That raised the risk of Europe's largest economy slipped into a winter recession. Output dropped 3.4% in March, more than twice the decline that economists had predicted. The decrease was especially pronounced in the automotive sector. And in Saudi Arabia, the economy expanded at a slower pace in the first quarter of 2023, and that was due to the oil sector, which grew at its lowest rate in more than a year. Saudi GDP rose an annual 3.9% in the first 3 months. That compares with 5.5% in the previous quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Is the Fed's job to help the banking system right now? I would say, this idea that they can separate monetary policy from financial stability, I actually highly disagree with that. The way monetary policy works into the economy is through the banking system. So some of this tightening is the intended consequence of tightening. This is now for the private sector and for the government to figure out what happens with the regional banks.
That was Priya Misra of TD. Phenomenal, as always. A bit of stability this morning. Looking at PacWest and a pre-market trading much, much higher off the lows we saw last week. It was a $10 name last Monday, dropped aggressively. It's basically an $8 name right now in the pre-market. We'll stay on top of that for you. Outside of that, in the equity market more broadly, on the S&P 500, positive by 0.2%. Going into CPI later this week. That's on Wednesday. Got a ton of Fed speak as well in between through the data points this week. Yields higher at the front end. We're up 6 basis points on a 2-year rather, close to 4%, 3.98, let's call it, on a 10-year, Tom, at 4 basis points to about 3.48.
John, one of the things we want to do is get qualified people to talk to, and we're going to do that right now. The story is extraordinary. Yelena McWilliams is a former FDIC chair, yes, a Kravis, Swain and more, but far more than that, she's enjoyed the failure of deposit insurance. Her father was flattened in Yugoslavia years and years ago over a failure of a bank. She wandered into Berkeley, sterling academic career, including service in the law business in Palo Alto, California. There's no one more qualified to talk about this banking mess than the former FDIC chair. Yelena, thanks so much for joining us this morning. Let me cut to the chase right now. Does this crisis have staying power, or are we solving idiosyncratic tech banking problems?
I would say, and thank you, by the way, for having me this morning. I would say that we're at the place where this crisis should not have had staying power. And yet here we are about 5-6 weeks in. And I'm hoping that we're at the tail end of that. The government does have a number of tools they need to use, and I'm happy to chat with you about what those tools are. But the problems are not so much idiosyncratic as much as at this point we have created a crisis of confidence in the banking system, and that's where we are.
How does real estate fold into this? Many will say, okay, it's not going to be the drama we've seen over the last number of weeks, but commercial real estate. What do you observe there?
A lot of the banks have actually, especially regional banks, have high concentrations and exposure to commercial real estate. In good times, they're generally able to navigate the concentrations in their portfolio very well. But again, we're at the point where there's so much volatility in the marketplace with the market expectations of the banks. And frankly, the empty offices in a number of commercial markets in the United States are not going to help that.
Yelena, should these banks be in that business? I mean, this is sort of one of the questions at a time where we're seeing the number of smaller and regional banks shrink dramatically over the past few years. Should it be their business to provide a majority of the commercial industrial loans and a majority of the commercial real estate lending?
You know, I think this goes back to the intrinsic question of the tiered banking system in the United States. You have different levels of banks and different sizes. So one of them, you know, you have community banks. They're generally banks below $10 billion in asset. You have mid-sized banks above that, and I would say below 100 billion. Then you get into the regional land, and that regional land is about 100 billion to as high as like 500 billion. Above that, you get into the very large banks. And the truth of the matter is that if those banks, the regional banks and mid-sized banks and community banks are not financing local real estate, commercial real estate transactions, they won't get financed. The role of these banks in the U.S. economy is so high that people actually, frankly, underestimate what these banks mean for our financial ecosystem. So should they be in it? Should they not be in it? It's almost irrelevant. They are in it. They need to manage the risk in their portfolios. And with the rising interest rate environment, it's going to be incredibly difficult for them. And frankly, the pandemic didn't help with people not wanting to come back to offices, and you have tens of thousands of square feet of commercial real estate, even in some of the most prime locations, sitting empty. You know, I was just in San Francisco a couple of weeks ago, and it's a ghost town.
Well, as a former regulator yourself, should there also be the same kind of regulatory scrutiny and requirements at some of these regional banks as there are at larger banks?
No, actually, absolutely not. And here's why. Our regulatory system needs to account for different tiers and different, I would say, strata in our banking sector. These banks present different types of risks than the G-SIBs, the global systemically important banks. They present different type of risk than mid-sized banks. And the job of the regulators is basically to accommodate that risk. The job of the bank is to manage that risk. The bottom line is when the bank fails to manage that risk, you get into in a situation that we have been in the past few weeks. But it's not, you know, as much a blame as we can put on the banks and the bank risk management in some of the failed bank situations. I think there is a portion of blame that goes on the U.S. government.
I just looked at the bank assessment rates at the FDIC and my eyes glazed over, Ms. McWilliams. I mean, it's complex to say the least. How much does J.P. Morgan or Bank of America pay each year for FDIC insurance? Do you have a number?
Well, there is a number. You can go to the FDIC. I don't want to single out a bank. It's a lot of money. It is a lot of money. There are two different sets of formulas. There is a complex bank formula. There is a less complex or a small bank formula. Go ahead. I'm sorry.
I don't mean to interrupt, but I am. Senator Warren would say raise the rate on James Dimon and Brian Moynihan. Is there wiggle room here for the big guys to pay more FDI insurance to take the load off the back of Andrew Jackson's 4,000 banks?
So it is very possible that the FDIC may just come out in that direction with the special assessment they need to impose to make the deposit insurance fund whole. As you know, some of the banks that have failed and have been subsequently sold have created a deficit for the deposit insurance fund. And as a result of that, there is going to be a special assessment, and I believe that's where the FDIC is heading.
Yelena, are you concerned about the Federal Reserve in its role as regulator? Do you put the blame there? It seems like everyone's just basically quietly blaming Randy Quarles and then leaving it at that. But do you think that this is something endemic in the oversight and the enforcement role that the Fed often plays?
Quite frankly, to blame prior, vice chairman for supervision for something that has happened about a year and a half after he left office is a little bit preposterous. But I do think, as a former Federal Reserve staffer, I was there during 2007, 8, 9, 10 crisis. I will tell you this, they're good people working at the Fed. They have a lot of mandates they have to satisfy, but we are at a place that is about financial stability. And the whole debate about monetary policy and financial stability, we're at the place, if these banks are not stabilized, we are not going to have financial stability. And so to the extent the Federal Reserve takes its financial stability mandate seriously, I think it's long overdue that they take a look at the banking situation in the United States and what the interest rate rises have done to the banking sector as they contemplate where to keep the interest rates.
Yelena, thank you for weighing in on all of this. Thank you. Yelena McWilliams there on the latest in the banking sector. Here's the latest right now. Luca Maestri over at Apple making a move. The CFO. They're kicking off a 5-part corporate bond deal. Tom, need some detail here on maturities and overall size, but if you go back to last August, they came out, I think, with a $5.5 billion bond issue, 4-part sale. $23 billion order book. So you can imagine what the order book might look like, Tom, for this one.
I mean, what they have earnings Thursday? Was it? We mentioned this. You know, everybody's doing this. They're coming out with bond offerings, even if they don't need the money. And they waited 2 business days till they come out with it. Right now, weight of debt at Apple 4.1%, which is absurdly low. Their cost of debt is 3.3%. The weighted average cost is 0.1% versus the equity, which is 9.7%. Do they need to do this? Clearly no. What are they going to do with the money?
Buy back shares.
I guess that's where we're going.
What they used the last bond issue last summer for.
And the maturities, Lisa, 2026, 28, 30, 33, and 53. And I'm going to call it the red herring, the bond. I don't know if the bond prospectus is a red herring, but they're the maturities right now. If you want to bring that up on the screen, guys, that's really important to go out to 2053. It's not like my Austrian piece, but there it is.
Well, these typically are longer duration bonds, and we have seen that from the Apples of the world to the Microsoft. When they sell one of these benchmark massive sales, they often are more heavily weighted to the long end. Is there a sign that they're trying to get ahead of more rate increases, or do you think that this is just simply creating liquidity in the market for their other shares, for their other bonds? I mean, I don't understand why they would need more cash, because they have basically the size of the German economy.
John, I just all weekend, the death of Apple, the death of tech, it's all overvalued. And that, at Cupertino, I don't think they got the memo.
Expected to price today.
Yeah, it's like 3 phone calls.
Traditionally, it's a good market timer.
Exactly.
Let's put it that way. Traditionally, it's a very good market timer.
Anyway, we have Rob Waldner coming up, right?
We do, yeah.
Perfect.
We can
Absolutely
have this
perfect,
conversation.
given this news.
Rob Waldner of Invesco. The latest headline, Apple debt offering in 5 parts. It's expected to price today. Rob Waldner of Invesco is joining us shortly from New York. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is still a very robust economy, so the tightening is yet to show up.
This is the Godot recession. We're still waiting for it.
The Fed's not going to quit until the labor market quits.
We've had this temper tantrum against the Fed and using bank stocks as a weapon against the Fed to try to get the Fed to change.
It's not up to the Fed to solve the banking problem. They did what they could do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. A Monday to get our heads screwed on straight. Many stories here. John Farrow focused on the senior loan officer survey. They're not going to mention Apple in that survey, are they?
Me and everyone else, I doubt it, Tom. 2 p.m. Eastern time is when that drops. This is about bank lending standards. They were tightening going into the financial stress of the last couple of months. Are they continuing to tighten, Tom? Enough so that it takes some of the jobs, some of the work away from this Federal Reserve who are looking to get inflation lower.
Certainly, we've heard from guests this morning that is the reality and that we're going to see a different bank. To me, and the key word I heard was scale, that we heard from Michael Purvis, I believe it was. The idea here of smaller institutions, less efficient institutions, and what do? You get tighter on lending. It's a serious issue for a huge body of America.
With the Federal Reserve seemingly on pause, and I say seemingly, that's the view of a lot of people. It seems to be implied by the dot plot from the Fed last time around in their projections, but ultimately, is good news good news? And on Friday it was off the back of payrolls data. Can we enjoy robust output data without the fear of this Fed spoiling it all, Tom, and hiking interest rates?
These are some of the battles, and of course, again, it's a timeline moving out. We had a comment from Mr. Bullard of St. Louis earlier where he's looking at the x-axis and it's farther out there. Lisa, your thoughts over a weekend of reading and just thinking about how the x-axis has changed off the bombshell report we saw.
We've been talking about the Senior Loan Officer Opinion Survey and how important it's going to be, and I expect that after 2 p.m., everyone's going to come out and try to discount it one way or another as being lagging and just reflecting the tighter credit conditions from higher rates. And this is exactly what Andrew Hollenhorst just put out from Citigroup, saying that, it's very difficult to tease out what is something that's inappropriate versus the intended design of Fed tightening. And so then how do you use this then to understand anything, let alone justify not raising rates in the face of relatively hot data still?
The 3.95% coupon out 2052, I should say, not 1952. Off the October bottom, John, the Apple piece is up 13% for an annualized 25% return on that long bond. Apple's going to make profit total return for people again.
So we've got a 5-part bond deal debt offering that prices today from Apple. Is this a real test of the debt market in the United States?
No.
We had LVMH out in the last month as well in Europe. These are high-quality companies, Tom. Very desirable, fantastic earnings, cash machines, if you will, with fat margins that are likely to produce big order books to suck up a lot of this debt.
The wheelhouse long ago, folks, one day, a brilliant woman from the University of Chicago walked onto the Bloomberg News floor, and they said, bonds. Lisa, this is your wheelhouse. I mean, literally, what, 4 phone calls are made?
Well, they actually are probably pushing people away. There probably are many more people who want to buy this than they have bonds
That's
to sell.
called oversubscribed.
So, correct. So it's a question of the allocation fight that you get, and it's going to be like a food fight for this, especially given the lack of debt that's been sold so far this year. To your point, is this a test of markets? And from Apple's point of view, is this a statement of the market condition right now, especially after earnings that came in better than expected?
And the ultimate responsibility of a CFO to look at capital allocation, John, they have 4% debt. which V. Bodie up at Boston University would say, that's not efficient.
I'm still thinking of Bramo, her first day walking into the office.
you
Why are
see
you
it?
all so happy? Why are you so happy?
More or less true.
Let me tell you why you shouldn't be happy.
My first day at the office, I'm sitting there and there's all these worthies around me. And they think I'm a journalist, fooled them. And I'm looking around and I'm going, Felix, Pulitzer Prize? Oh, William Ahern, Rand Associated Press. The worthies I was surrounded by. Yeah. I was completely out of my element.
Very cool, Tom.
Yeah.
Very cool. Pushing ahead to the rest of the week then. Data. CPI coming up on Wednesday. Lots of data. PPI the day after. Tom mentioned slews. I hate that phrase, slews. I don't like calling it slews. Senior Loan Officer Opinion Survey coming up a little bit later. Neither do I.
Yeah, I can't.
2 p.m. Eastern Time. That's coming up. Looking out for that with the equity market right now on the S&P 500, just about positive, up by 0.2%, Tom.
Very quickly, we've got a wonderful guest. Gold 2030 has the attention of people like Christopher Verone. He's enthusiastic on gold. We get beyond lucky. He was previously scheduled to talk about the boring bond market. Rob Waldner joins us, chief fixed income strategist, head of macro research at Invesco. Rob, I'm going to rip up the script and I'm going to keep you out of your compliance office because you can't talk about individual names, so we're not going there. But when a big company comes out with an offering, 5-part, 6-part, or whatever, is it the stereotype, the cliche? They call Fidelity, they call Invesco, they call PIMCO, and the whole deal's done?
Well, Tom, I think that this is going to be very well received by the market because if you look, we have seen, quite a lot of demand for high quality fixed income, and I think the value proposition is quite good because we have, positive real yields. We have spreads, which put the average of the investment grade market at about 5% in total yield. Apple will come inside that, but we've had tremendous demand, and actually, there's more demand for industrials than there are financials. We've had a lot of financial issuance. Financials are wider, while industrials remain quite well supported. So, I expect a deal from a high quality issuer would be very well received.
I look, Rob, at where we are. And it's simple. Do you buy them for maturity? Are you buying them for a trade?
Well, I think if you're a medium-term investor, you can buy these to earn, somewhere close to 5%, probably a little bit below 5% over a multi-year period. I think that would be where a 10-year would come. That's pretty good for getting that level of income in a very safe asset that is likely well protected, even if we get some sort of economic, slowdown or recession. Seems like a good investment from a medium-term perspective.
Rob, away from Apple's pricing, can we talk about what it might signal? Larry McDonald has talked a lot about this. Brings up the timing of Luca Maestri over at Apple, who just seems to time this debt market phenomenally well. And what often happens if you plot it on a chart is that they come out with the bond issue and soon thereafter, you'll start to pop higher again, Rob. Now, I'm just wondering for someone like you, if you pay attention to things like that.
Well, John, I think that very well may happen here because we have this bond market in a very interesting place, right, where the yield curve is steeply inverted. So from a bond geek perspective, that means that you get negative, the further out the curve you go, kind of the less you're paying. And so if they can kind of feather in some of these longer maturities, we do think we're probably in a range, and we're probably closer to the bottom of the range with this market that is caught between disinflationary slow growth and a very aggressive Fed. So there's room for the market to move back up. And so in the short term, this may prove, a good place for them to do issue.
Does it make sense to you for them to raise money at all at a time when money actually costs something, given that they have a cash pile the size of a pretty big economy on their balance sheets?
Well, I can't speak to their capital allocation. I don't have much information there, but it would make sense as part of a medium-term strategy to manage your liabilities. I would have thought to continue to be active in the market.
Given the fact that there hasn't been that much debt issuance, can you talk a little bit about the food fight that would emerge over allocations in this type of deal? How much the paper might trade a lot tighter than people would otherwise expect. The deal that Apple gets will be much better than people expect simply because there has not been that much supply.
I think it comes back, Lisa, to what I was saying, which is, if you're a medium-term investor, there's really quite a lot of opportunity here to lock in what seem like pretty good returns. And I think this is for the broad IG market overall, not just for an individual issuer. But, if you think you're going to get something close to 5% for 10 years, which is where the IG market is, and those are high-quality issuers. So whether we have recession, whether we have, whatever those, you should be relatively well protected from default. That's a pretty compelling value proposition, and I would expect there to be quite a bit of demand. As you point out, you can have, oversubscriptions and the issuer tightening these things in as they talk the book up. But we'll have to see how that pans out.
Rob, last Monday, we had an ISM manufacturing prices paid component push yields about a bit, but on the same day, a ton of IG issuance as well pushed yields higher. I understand from our team here at Bloomberg, Michael Gumbel leading our reporting, that we'll have 15 borrowers tapping the investment grade market today, 5 billion coming from Apple, potentially. Rob, does that have the potential in size to push around the Treasury market a little bit through this session, through today?
Certainly a large amount of issuance can push things higher. I think what's also important is how much demand that we get. Overseas demand has been very important to the market. And so I think that the medium term, it's all going to be about the macro fundamentals. Short term, it can be knocked around by issuance or supply demand issues, but medium term, it's all going to be about the macro fundamentals.
Rob, we got to make some news here. Do you get a call from Luca today? I mean, when there's a deal like this, does he dial 1-800-INVESTCO? You pick up the phone and, you go, how things going? I mean, help me here.
Well, I think, Tom, we have a, very solid corporate trading desk, constantly connected to all these issuers. And they do a great job, and I'll leave that to them.
There's some media training for you, TK, right there.
We've got Atlanta Braves tickets. Come on down.
Rob Waldner, INVESTCO. Rob, thank you, buddy. Thank you very much. I don't think Luca needs to call anyone.
No.
Yeah.
I think they're all sort of like...
Yeah.
Well, to your point, John, you were great on it. LVMH was a feeding frenzy.
Yeah.
And why is this any different?
You'd expect a high-quality company with fat margins to come to the debt market and do exactly what it wants to do. They don't have to beg anyone.
Back in 2013, there was an investigation over the allocation process because a lot of the smaller investors felt like they weren't given a fair shake from some of the syndication desks in order to have an opportunity to buy the debt. So, it's that kind of deal.
Coming up shortly, about 8:30, 20 minutes from now, we'll catch up with Dilip Singh of PGIM Fixed Income. Used to work for this administration, so really interesting conversation potentially around the debt ceiling. Look out for that in about 20 minutes' time. From New York City with your equity market higher by 0.2%. On a beautiful Monday morning in New York. Did you feel spring, Tom?
Yes,
Turning slowly into summer over the weekend.
Yes.
Beautiful feeling. When the sun hits your skin, that warmth, Bramo, makes you smile.
Summer for a day.
When you feel happy.
And then we get winter again.
When you feel happy.
No, I don't know. I'm not familiar with that.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there are no good options for solving the debt limit stalemate other than Congress lifting the cap. Yellen told ABC that the White House resorting to the 14th Amendment would provoke a constitutional crisis. President Biden discusses the matter with congressional leaders on Tuesday. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. Now, the 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest, which was jammed with ammunition. It's a holiday in the UK following the weekend coronation of King Charles III. The crowning ended Charles's 7-decade wait for the throne, and it marked a turning point for the UK and the monarchy as it tries to adapt the current era of technological and social change. The king told a packed Westminster Abbey that he had come, quote, not to be served, but to serve. And President Biden will announce that the government is drafting new rules on airline benefits for stranded passengers. Carriers could be required to provide meals, hotels, and additional compensation due to canceled or severely delayed flights. Authorities say they expect air travel this summer to surpass pre-pandemic levels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Banks fail every single year, right? It's just not usually the 16th largest bank by assets, and that's what really caught people's attention. And so, I think we could see continued stress in the banking system broadly, but very much at the lower end as we work through some of these COVID excesses and we work through the duration mismatch that we know exists today. I'm not sure that we're out of the woods, but I do think that the big booms have probably been heard.
Fantastic from David Leibovitz, the global market strategist at JP Morgan Asset Management, starting a new week without much sign of stress at the moment, on the surface at least, and some of those banking names we watched throughout the whole of last week, PacWest being one of them, slashed their dividend, said business was sound still. Their stock is running in the pre-market. Elsewhere in the bond market, a lift in this whole curve now, 2s out to 30s. Your 2-year is higher by close to 8 basis points in the Treasury market. Your 10 years up by almost 6, getting closer to 350. We learned a little bit earlier on this morning that we'll get some bond issuance later from Apple, a $5 billion offering, Tom, across 5 parts. We'll have 15 borrowers coming to the U.S. investment-grade market today. So that's kicking around the Treasury market just a little bit potentially through the session today.
Constructive. And, John, note oil from 70 and the worry of 69 a barrel. West Texas Intermediate, 73.31. Even they're cooperating a little bit. I mentioned gold earlier, up $6, 2,000 at 31. One of the things we realize is the small banks of America are not going to be salvaged by Fort Knox and gold holdings. Herman Chan is expert at this. Herman knows that there is no gold at PacWest or the others. And yet, off of the Friday Joy, they have a, quote, fundamentally sound relationship banking model. Mm-hmm. Is it a smaller model? Is everyone going to be downsizing into 2024?
I think you'll have a more conservative balance sheet across the board for regional banks, less interest rate risk, less interest in putting riskier loans on the balance sheet just because you don't know what's going to happen over the course of the year.
So then which ratio do you follow? I mean, if there's less growthiness, including tech idiocy like 1% mortgages and, the marketing game that we saw that was a disaster outside San Francisco, fine. Move on from that to the new model. Is it going to be where high single-digit, even dare I say double-digit bank returns become mid-single-digit? Is that the shift you have to make?
I think you're going to have to make an expectation that banks aren't going to really grow their balance sheet this year because of the deposit issue with deposits flowing out of regional bank balance sheets. That means there's just less ability for banks to lend. And they're going to be less impactful in terms of having the appetite to lend just because there's a recession potentially coming down the corner. And you really want to be careful in terms of what risk you add to your balance sheet. You don't want to compound the problem of the interest rate risk with credit risk.
2 p.m. Eastern Time, Senior Loan Officer Opinion Survey, much anticipated. What don't we know already that we're looking for from that survey later on this afternoon?
We just want to confirm in terms of how much pullback the banks are doing in terms of their appetite for lending. So that's the biggest takeaway that we're expecting coming in at 2 o'clock later this afternoon.
Will it matter, or will it just be so backward looking that people will discount it?
I think it will matter because it'll be a confirmation of what banks have talked about in the first quarter earnings call. We have heard some regional banks talk about narrowing the credit box a little bit on the margins, not being as aggressive in certain areas like auto lending, leverage lending. So areas of lending that don't offer the best risk-adjusted returns. And so we're looking for more confirmation of that in the senior loan officer survey.
We were just speaking with Jelena McWilliams, formerly of the FDIC, and she said that, there is some concern that there wasn't accurate stress testing of just how high, and I'm butchering the way that she said this to some degree, just to be completely fair, but there is a question around whether there has been recognition of what higher interest rates and the speed in which they were raised will do to the banking model of the regional banks. Do you think that we have our head wrapped around that yet, or do you think that that still is a mystery to a lot of people on Wall Street?
Yeah, so I think of banks like a Goldilocks industry. You don't want to be too hot, you don't want to be too cold, and with the economy being too hot last year and interest rates rising as fast as they did, things tend to have an opportunity to break, and we saw that with SVB and with First Republic. So I think now there's more of an appreciation of the risk that banks have on their balance sheet, and I think the entire industry, the analysts, the investors, the regulators now are more attuned to the risk on banks' balance sheets.
I have never read the sluice. I go, okay there?
That's beautiful.
And I noticed, like with 18 paragraphs, there's 11 footnotes. Right. Herman Chan reads all the footnotes and everything. If we know those guys in Washington have knowledge about these banks that we don't have, do you get that knowledge in the sluice?
You get There's more data in the sluice in terms in terms of the idiosyncrasies to what is really driving the demand and supply of lending.
Tom jokes, but do you know how many people will open the Senior Loan Officer Opinion Survey for the first time?
Right.
Later on this afternoon. It will be the first time for many people.
Exactly.
A lot of people in the Treasury market, a lot of people more broadly, economists do look at these things, but I think this is the first time in a long, long time that I can think of that this has become a key focal point. When you open that later, what's the first thing that you and the team will look for?
We're just going to look for what the survey says in terms of loan supply. Are banks pulling back on credit availability? And what's driving that pullback? Is it going to be concern about the economy? Is it concern about credit? Is it other competitors pulling back as well? So all of these things are important as we look ahead for the sluice.
Is the demand component to it interesting to you?
The demand component is as well. So there's a little bit of both in the sluice. So you get a flavor in terms of really both sides.
Are you expecting that the loan book will come down simply because companies are not borrowing, companies are not investing, that there's been a lack of confidence in the C-suite that possibly exceeds the lack of confidence that we've seen from consumers?
I think so. You're seeing commercial loans and commercial real estate loans in particular pull back a bit. And so that's just the expectation for banks in general for the regionals that we cover is that there's just less demand. A couple of regional banks have talked about less capital spending. So that all feeds into the demand component as well.
Herman, this was great. It always is. Thank you, sir. Herman Chan there of Bloomberg Intelligence, looking at PacWest in the pre-market. 775. It was 10 last Monday. I can tell you through last week, it just got absolutely hammered. The low of last week, 248. Thursday, Tom, intraday, 248 on PacWest last week. It started the week as a double-digit name.
Yeah, it's huge gyrations, and I think there's a real mystery out there. And again, I go to this word of the morning, which was scale. They're losing scale. How do you do better losing scale? Show me an industry where that works out.
And what's the playbook going forward for some of the banks as they start
Given
to
that
need
they're
capital?
Smaller,
Over the weekend, there was a story about how the government is trying to rearrange their loan loss sharing agreements to possibly allow for private equity to come in and involve themselves more aggressively for the bidding. And the argument here is to bring down the pricing so that they get a better deal, right? So that they basically, the government loses less money. So far, they've required bank charters to really participate in this, which left JP Morgan and some of the biggest regionals as the only players in town. Now they want the KKRs, Apollos, et cetera. I'm just, giving the names of some big private equity firms, but to possibly come in and play in a more robust way. How much does that change the
field?
field?
A greater financialization. That's really what it amounts to, a whole set of new players.
I saw someone say this week, and it's attached to this conversation, that they'll have confidence in the system once you start to see private sector solutions without federal backstops. That once you start to see that, they'll feel more confident about the situation. Yeah. I don't think we're going to see that anytime soon based on the template that was delivered by First Republic and JP Morgan, because there'll be some people that just look at stress and say, there are benefits to waiting.
Especially given the fact that they have assets that are fundamentally challenged, that if they liquidate, they can't meet their obligations. It's a huge issue. It's just an insolvency issue that really creates a problem for the FDIC.
A lot of people are saying they're not near the liquidation part, but then you don't know which single banks are out there. Michael McKee emailing in saying, Tom, do the work. So I did the research on the sluice. I did a word search off of Fed minutes, and we looked at some, several, a few. None of that verbiage is in the sluice. The sluice is different than the Fed minutes.
It's not the participants.
The only thing they have similar is I've never read either of them.
I believe that. Coming up, allow me to promo another property of mine.
Before you leave.
Bloomberg TV with a cheesy smile. Very American TV, that is, you know.
It is.
Another, you know, look down the barrel of the camera,
It's coronation free today?
Need to get my teeth. Kathy Jones and Charles Schwab, Brian Lefford of Investco, Stuart Kaiser of
Stuart
Citi.
Kaiser, good.
Hey, all the jokes about British teeth, give me a break.
Okay.
Come on. Come on. Come on. From New York. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Surveillance, and good morning to you. Lisa Bramwitz and Tom Keene. John Farrell preparing for the next hour as he chooses to do. Futures up 10 And the VIX well under 18 right now after the gyrations on Friday, 17.46. Lisa, I'm going to look at a substantial move in the 2-year yield, buttressed right up against 4%, 3.98%. That gets my attention.
A lot of people were wondering why we didn't even see a greater move in the 2-year yield last week, just simply because we got hotter than expected inflation reads and that labor market report. What was it, the 14th consecutive month that we got a non-farm payrolls report that exceeded expectations?
And I was doing the work in real time there at 8:30. Jason Furman did better work up at Harvard doing Ec 10, where he took the quarterly 3-month average, which I think is a nice way of doing it. And the answer is we talked to Krosner about, it just goes out at 245,000, 265,000 per month. That has to break, and it hasn't broken yet.
And there's been a slow drip, but not fast enough to get people some confidence. We are seeing some stability around all of the asset classes. What I find interesting is that the dollar, more days than not, has lost, right? We have seen a weakening in the dollar, even though we haven't necessarily seen a huge fall off in the economic data. Good news was good news for equities, but the dollar still faces some headwinds as people wonder whether perhaps we saw the peak earlier.
This is just out. I wouldn't have time to discuss it now with our good guest, but Robert Schiffman, who's really good at Bloomberg Intelligence, he asked the money question of the day. If Apple has so much cash, why borrow even more, question mark? We'll try to bring that to you here in the next 30 minutes. Apple, with the rating now, why don't they have a AAA rating? I mean, I don't know. Maybe it costs too much. That used to be the crux years ago, a few, but it's a AA plus rating.
Why should the U.S. have a AAA if they're about to default? I mean, you could say that Apple in some ways is, well, I mean, this is really a big question, right? What's in a credit rating and how important is it to maintain that and what's required to do so at a time when it is so rare, even for a behemoth, again, with a cash pile the size of a pretty big economy?
Let's get smart on this right now. Dalip Singh joins us, chief global economist at PGIM Fixed Income, with serious experience recently in the White House. Dalip, in the office, is it tomorrow? They're going to have a meeting, a confab on the debt. It's all politics, isn't it?
Morning, Tom. Morning, Lisa. Look, talking is always better than not talking, but I'd be surprised if we get a decisive breakthrough tomorrow. The incentives are just not yet in place. McCarthy could lose his speakership if he folds early to the president with a clean increase in the debt limit. The president can't give a nod to anything near the scale of spending cuts proposed by McCarthy because they would undercut much of his domestic agenda and lose his political base. So I'm afraid market stress is still what's needed to create cover for face-saving compromise. And that's why, perversely, market complacency is self-defeating.
You and Gene Sperling have been very good at this, of trying to link this policy dynamic into Wall Street. As Lisa mentioned earlier, Wall Street seems soundly removed from this discussion, this debate. Are they correct on that, to be removed, to not worry about this debt crisis?
You know, look, it's muscle memory. And that muscle memory is dangerous because the context has changed pretty dramatically from the last time we had a serious flirtation with default back in 2011. For one, Congress is as polarized as it's been in our country's history. Second, you know, we are trying to roll over a debt stock that's twice as large as it was in 2011. 3, foreign holdings of treasuries are up to $7 trillion. That's almost $3 trillion higher than what we had in 2011. 4, back in 2011, Europe was in an existential debt crisis. China had yet to lure serious inflows from abroad. Digital assets had yet to go mainstream. There were no alternatives to dollars. That's changed. And lastly, and I think most importantly, we're currently, the U.S., spearheading the most severe economic sanctions campaign against a G20 country in financial history. That creates incentives, geopolitical incentives, for countries to hedge. The debt ceiling just needlessly adds impetus to those incentives at a time of geopolitical peril.
Why do you think, Dalip, from your vantage point of having worked at the White House, of having worked at the Treasury, of having worked at the Fed, all of these different agencies, why do you think things have gotten so dysfunctional in Washington, D.C.?
Yeah, I mean, the debt ceiling really is just symptomatic of that polarization, Lisa. I mean, I think it's derivative of the atomization of the media, extreme levels of inequality, and technology that allows political movements to gain scale at speeds that we haven't seen before. And look, now we're on the cusp of doing something that great powers just don't do. They don't default. They don't talk about default. They don't think about default. And your measure of greatness is when no country questions whether you would ever do so.
Some people,
so it's brought us to this point.
Some people would say, Dalip, that there already are economic consequences to even having this discussion in such real time, and given the fact that it does have a different kind of more polarized nature to it. What are the longer term impacts, even if there is a solution that is found at the last minute when the market finally wakes up and applies the real pressure that Washington's waiting for?
Lisa, dollar primacy is a national treasure. It allows us to fund our government at 20 to 50 basis points cheaper than it otherwise would. That adds up to real money, $150 billion for every 50 basis points on treasury yields. It allows us to absorb a shock, like the 2011 downgrade of our credit rating, and it allows us to deliver a shock. All of that is being put at risk in terms of the long-term scarring effects of this type of debate. Just remember, dollar primacy is nothing more than a network, okay? It's rooted in trust and inertia and an assumed lack of alternatives. But every network, whether it's in biology or ecology or in finance, they have tipping points. They're usually psychological tipping points that you can't see in advance. And we're now pushing ourselves towards what I would consider to be a very dangerous place the closer we get to the X date. So this is very serious. A lot is at stake.
Well, this is actually a really important point that a lot of people argue against, saying that the loss of the dollar's supremacy as the global currency has been overstated. The death of the dollar has been perhaps overwrought. However, other people like yourself saying, actually, it's becoming much more real. What are you looking for in the data to show that that is actually what is transpiring, that people are moving away from the dollar as the main dominant currency of exchange?
You're not going to see it on paper. I mean, the measure of primacy is really, do you use the dollar to buy or sell stuff? Do you use it to borrow money? And do you use it to price transactions? And on paper, there's nothing to see here. This is a tail risk, but we're gambling with an exorbitant privilege that has incalculable benefits. And so it's the kind of tail risk that you should never take. That's the point.
I looked, Dalip, at this, and it's a history which you studied at Carolina and also up at MIT. The ageless history of our debt caution, I'm going to call it our almost debt religiosity. What do the people where they say, we got to get rid of the debt, it's just like Apple's corporate debt. Heilbronner and others wrote a book 40 years ago saying, no, it's not. How do you respond to people that viscerally feel this government debt is bad?
Yeah, this is a legitimate question, Tom. I don't think we're in a crisis, however. So long as our nominal GDP growth is higher than the average interest we pay, the math of debt sustainability improves over time. And right now, that's the case. Our nominal GDP growth year over year is about 7%. It's actually been in the double digits for much of the past 2 years. The weighted average interest rate in our public debt is 2.6%. Now, for that to be sustained, of course, the market has to believe the money we're borrowing will be put to productive use. That's the key question. And I think, look, that argues for the kind of investments that the public sector is making where the private sector is underinvested. R&D, infrastructure, technology, programs that grow a workforce, make them more productive. That's really the measure of whether the debt that we're borrowing is going to raise our nominal GDP growth to levels that can sustain a rising interest rate cost.
And with that beautiful explanation, good enough for Olivier Blanchard or Joseph Stiglitz, if they've studied this as well, wrapped around our start and the rest, the trust mechanism is that government will put it into good projects. Can't that be discussed tomorrow among a fractured polity in Washington?
It can, but not with a gun to our head. The consequence of not reaching agreement can't be, we're going to burn the house down. We absolutely should have a discussion about spending and revenue levels. How are we going to use our resources to solve structural problems that the private sector won't solve by itself? Extreme inequality, social disparity, vulnerabilities in our supply chains, the climate crisis. All of that should be on the table. The point is, how do we have that discussion in a way that doesn't make us a global spectacle?
Right.
That's the question.
has been wonderful. Dalip Singh, my most favorite discussion so far on this debt idiocy. He's with PGIM Fixed Income, of course, his public service to the nation within the Biden administration. Lisa, here is the exact quote from truly an expert on these bond offerings. Robert Schiffman is priceless at Bloomberg Intelligence. Quote, progress towards the net cash neutral goal should benefit further from its planned 5-tranche bond issuance particularly with proceeds targeted for shareholder returns that likely exceed $100 billion in 2023. That goes exactly to what you were saying.
And this really flies in the face of the narrative that people have been putting out there, which is that the era of borrowing money in the bond market to buy back shares was over because the relative value proposition didn't look as good. Well, for Apple, evidently it does. And basically, they've got nothing else to do with their money except for buy back their shares, which will only make their shares more valuable, given that there'll be fewer of them. It just really raises a question, Tom. Is there really just a tale of two halves here? The companies that can do this and those that can't get capital, that can't get financing, that are struggling in some sort of credit crunch, and it causes that, dichotomy even to grow greater.
I would suggest it's always been the case. I just am not going to believe that there was a We Are the World, everybody got bond deals done in any decade in the last 100 years or so, even 200 years. But I will say the concentration here of superiority, Michael Mauboussin way out front on this at Credit Suisse a million years ago, it's the concentration of these tech companies and other big companies as well. John's favorite LVMH, it's same thing.
But does it get even easier and easier for them to dominate at an era where it's even that much more difficult for the have-nots to gain financing? In 2013, 2014, 2015, companies were getting financing that people were thinking to themselves, how is this possible?
It's a $5 billion tranche, right? The 5 tranche deals, $1 billion each, boom, 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 boom. I got $110 billion short-term debt, long-term debt for Apple. So it's, for Monday morning TV and radio, it's 5% they're going to add on.
Right, but it's nothing compared to the debt loads of most companies. And this really is just because they can and they will. And there is plenty of demand, as we've been hearing about.
Did you get a phone call yet? Maybe that's why Farrell left.
to go answer the syndicate desk of Barclays. Yeah, something
John,
like that.
how much would you like?
They've got plenty of demand.
I can see. There it is. We'll keep you abreast of this. It's an important story. We make jokes of it, but truly historic to see this corporation come out with another deal. Adam Tooze coming up. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Joe Biden and Kevin McCarthy have arrived at a crucial moment in their debt ceiling fight. The president hosts the House Speaker and other congressional leaders at the White House on Tuesday. McCarthy wants spending cuts as a condition of raising the debt limit. The president wants to separate the issues. A default would rock the markets, and the White House says it could cost millions of jobs. A new poll shows President Biden's approval rating hitting a career low. It also shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44-38. Russia reportedly has at least 300,000 troops inside Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. First quarter earnings plunged 26% at KKR. A deal-making drought continued to weigh on the alternative asset manager. Meanwhile, assets under management grew 6% to $510 billion. KKR's traditional private equity portfolio fell 9% over the past 12 months as a firm marked down the value of investments. An amusement park operator, Six Flags, reported first quarter revenue that beat estimates. Attendance was 1.6 million. That was down almost 6% from the previous year, but still better than expected. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The truth of the matter is that if those banks, the regional banks and mid-sized banks and community banks are not financing local real estate, commercial real estate transactions, they won't get financed. The role of these banks in the U.S. economy is so high that people actually, frankly, underestimate what these banks mean for our financial ecosystem.
Elena McWilliams, former chair of the FDIC, and again, I can't say enough about how she has experienced what so many are going through. She was wiped out, her father was wiped out, rather, in Yugoslavia during one banking crisis. She wandered over to America, excelled at Berkeley, and has moved ever higher in the legal business, and of course, her tenure at the FDIC as well. This is a joy, and we had a huge response when Professor Tooze joined us a few weeks ago. He is a Columbia University history professor, but far more than that, was he Barton Biggs professor at Yale University and had to replace the giant Paul Kennedy. Very quickly, Adam, what was it like trying to replace Paul Kennedy at Yale? I can't imagine.
It was definitely a lesson in humility, to be absolutely honest. I mean, Paul is still going strong, it should be said, because when I left, he came back, and he's absolutely firing on all cylinders. But yeah, a legend in his own lifetime.
Adam, your essay in March is my early choice for essay of the year in the Financial Times. You beautifully walk through the $1 trillion rebalancing as we move from pandemic to polycrisis. What is this polycrisis we're living, and when does the joy end? When do we rebalance to some form of stability?
I think the absolutely first lesson, Tom, is that we probably don't. I think we actually have to abandon that assumption that the best way to think about the world is as a self-equilibrating system that will move back to normality. If you just look at the narrow space of finance, does that seem like a reasonable description of the world that we've been in since the 2008 crisis, or if you're talking about Japan since the late 1990s? It doesn't seem to me to be that kind of reality. And that's a little bit, I think, what we're seeing in the banking, this mini crisis that's unfolding in the banking system, where ultimately the big driver of that is the interest rate shock, right? And the interest rate shock comes from where? Well, it comes from this unprecedented surge of inflation, which is quite unlike any inflation we've seen before, and follows immediately out of the COVID shock, which ditto is also quite unlike anything we've seen before. So I think we're in this very broken play, a world of a series of not just serious, but quite unique and rather unprecedented disruptions.
Well, and Adam, you say that one of the responses to it has been basically bailouts and the sort of moral hazard of not allowing failure, which you've seen in some of the banking institutions in a prior life would have been considered too big to fail or systemic or any of these natures. So what does that do in terms of the zombies? I know that Tom's been talking a lot about the zombie roll-ups. Do you think that we end up with a host of zombies or zombie assets that kind of are allowed to persist in a sort of inefficient manner for a longer period of time?
I think we clearly need new forms of discipline. We need new forms of workout. And if you look in the legal space, if you actually look in the mechanics of bankruptcy restructuring in the United States and indeed across the world, lawyers and corporate financial officers are very actively engaged in that process of trying to figure out new forms of discipline, which aren't simply the old-style Darwinian process of free-fall bankruptcy, which is increasingly the exception. Right? There are forms of discipline which don't have to consist in systemically dangerous bank failure, which is the sort of type that we have been at risk of. But certainly, Liz, you're right. We need to be thinking very hard about how we adjust and how we find new forms of, yes, discipline selection, if you like, in Darwinian terms, to avoid a process of ever greater zombification.
Well, this weekend, when I was reading about the regional banks and sort of where we are and the amount of lending that they account for and the amount of real estate, commercial real estate in particular, that they lend to, I wondered, is this model being challenged? Is the private sector, private equity, private debt, some of these private financing companies taking over a greater share of the business that regional banks used to do and really render them less necessary?
I think it's actually, I would say, rather the reverse, a very healthy reminder just of the actual structure of American society and American business, which, as Mac Williams was saying, is firmly and solidly rooted in not in the very large businesses, but in a deep undergrowth of small and medium-sized enterprise. That's where a huge part of the job creation goes on. And the bank ecosystem that the United States has is internationally unusual. Right. America has a lot of banks. But what I do think we need to be taking care of is exactly as you say, the huge shifts which are going on. And in terms of risk going forward, in a way, I'm more worried about that new private equity zone of very untransparent finance, trillions of dollars worth of it in, say, the leveraged loan market, than I am about the FDIC-regulated small and medium-sized banks, which on the whole, when they're not terribly managed, like Silicon Valley Bank was or First Republic, are a crucial part of the American economy.
Adam, you straddle both sides of this with your academics. The book, folks, is Shut Down, How COVID Shook the World's Economy. Adam Tooze can't say enough about this effort from, I'm going to call it 18 months ago. And Adam, I want you to address the polarities in our politics with the too small to succeed. I'm absolutely fascinated by the focus of an America that is succeeding, like Apple with an effortless 5-tranche bond offering this morning. That's all, Bloomberg surveillance babble. There's a huge body of America that feels they're too small to succeed. Where are they in a number of years?
This, I think, has got to be the big worry. I think we're seeing the bifurcation or maybe even a three-way separation of the U.S. economy right now. There are big slices of it which are continuing to thrive. Think of the innovative energy space, the CHIPS Act, the kind of money that's pouring into a genuine revival in manufacturing investment. But those are big players. And what I think we have to worry about is the credit crunch, which looks as though it's beginning to unfold. If you look at bankruptcies amongst smaller businesses, those numbers are beginning to spike. That will, as it were, make that divide, dig that ditch ever deeper. And that's ultimately, I think, what is then reflected, as it should be, in democratic politics, which ultimately, in distorted ways, for sure, but nevertheless does reflect the broad tidal shifts in American society. And at this moment, we are, I think, beginning to see the point at which the extraordinary labor market story, which is, after all, a huge success of the recovery from COVID, and America's never seen unemployment numbers like this, could be tipping into something rather different, which would be a sort of two-speed recession or two types of landing. We've talked a lot about hard landings and soft landings and no landings. What if one bit of the plane lands quite hard and the other bit, as it were, soars away?
Well, just quickly then, you mentioned that you are concerned that there's an increasing role of private capital away from some of these smaller banks that is playing a part in what you see as sort of this bifurcation that's developing. Can you explain, can you elaborate on that?
Well, that, I think, will be a third element. This is where the story gets really complicated, because I think the credit squeeze is going to run through the stressed balance sheets of smaller banks. The bit which I think is riskiest, in a sense, not risky the way that a Citigroup getting into trouble in 2008 or a Lehman in 2008 is risky, but nevertheless high risk, is precisely the space. But they are very untransparently linked at this point. And it's not by accident that in bankruptcy in the United States today, the private equity-owned firms are absolutely dominating the corporate, if you like, restructuring and crisis market. That's where this sort of capital goes to play. The returns are outsized if you can get in, and the privileged elite that can play in this market earns those returns. The question we're going to face now is what happens when the risks come home to roost, and where the safety nets are, and whether they're even appropriate to have safety nets for this kind of actor.
And the new financialization as we move into the decade. Adam Tooze, thank you so much with Columbia University. And earlier, you addressed this earlier, Lisa, this idea of the players with money up to their eyeballs looking to do something. And that's when I say financialization, what we're talking about. And there's a body of America that says, hey, what's in it for me? What's in it for us? And the answer is, well, we're going to form jobs.
Well, to me, the idea that LVMH and Hermes came out with these incredible earnings, incredible profits, and then Tyson Foods, a chicken producer came out and downgraded its expectation for the year because consumers were downgrading to less expensive options, highlights this bifurcation in realities from people with plenty of money for discretionary spending and those without.
Yeah, I think it's a more complicated nuance there in terms of luxury goods and maybe the reopening of Asia versus Tyson and the very complicated dynamics at Whole Foods of shifting from beef where you go, really? to the other stuff, really? And then you get to chicken and everybody's lined up at the frozen chicken things, buying their Bell and Evans and, the rest of the overpriced stuff. What an extraordinary Monday. I believe we're going to do this again. In the meantime, William Gross, PIMCO co-founder, stamp collector, in the 1 o'clock hour. Good morning on radio, on television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get your week started. Live from New York City this morning. Good morning, good morning. Your equity market just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Yellen says it's all on Congress to lift the debt limit. PacWest leading the rebound after slashing its dividend and looking ahead to the latest bank lending survey. We begin with the big issue, stuck between bank stress and resilient data.
The economy is pretty darn strong.
The economy is resilient here.
The U.S. economy has proven a lot more resilient than people thought.
You've got an incredibly resilient, durable economy.
But that doesn't change the fact that there are indicators pointing to a recession.
It's pretty clear that the largest banks, the smallest banks, are tightening their belt.
We have a lot of questions that are hanging out there.
In particular, of course, the tightening of credit conditions.
We're seeing a tighter lending environment coming up.
Metrics like the Senior Loan Officers Survey.
It's going to say that credit supply is tightening.
What we're left with is the Federal Reserve with a tight monetary policy in place.
Things break where there are the weak links.
Idiosyncratic, we've heard that word a lot for the U.S. banking sector, but I don't think it's that simple.
Banks will make it harder for consumers and corporations to get loans.
It's going to squeeze the one thing that's holding up the U.S. economy, and that's the U.S. consumer.
Joining us now to discuss, Schwab's Kathy Jones, Invesco's Brian Levitt. Kathy, wonderful to start the program, start the week with you. Kathy, how long before we're talking about a June rate hike?
Well, I think it's probably already on the table for a lot of people, but I really think that at this stage of the game, the Fed had indicated that they're probably on hold for a little while, and for good reason, that they probably will hold off. But the talk will probably start as soon as CPI is out later today or later this week.
Good news was good news on Friday. Data robust, equity market up. I wonder if that can stick, Brian. Deutsche Bank's Brett Ryan saying this. They've lost that hiking feeling. Brian, the Federal Reserve's lost that hiking feeling. So can we enjoy, Brian, the benefits of good data without the threat of rate hikes?
No, I think if you do get good data, then the threat of rate hikes will come back in. But I certainly hope that the Federal Reserve is at the end of its tightening cycle. This is an incredible amount of tightening over a very, very short period of time. And we still haven't seen the lagged effects of all of it. You know, this, as everyone says, it takes 12, 18 months to work its way through the economy. The money supply on a year-over-year percent change is negative. So we have a good sense of where inflation is heading. Plus, as your intro suggested, the banks are tightening lending standards, which is even additional tightening on this economy. So I hope that the Federal Reserve is done, and the economy will slow down given the lagged effects of all of this tightening.
In the meantime, then, Brian, is good news for this equity market?
Good news will ultimately be good news because you start to get more of a soft landing feel. Now, that's not necessarily going to, maybe that's a little bit too hopeful, but that's the way the market took the jobs report, which is, look, inflation's coming down and the economy is still resilient. So the market is going to applaud that. Ultimately, I think that this economy does moderate. You will see some retracement of recent gains that we've had in the market, but that's a very tactical call. I would ask investors to look out over the next 1 or 2 years rather than the next couple of months. Typically, once inflation has peaked, once the Fed is done tightening, markets tend to do very well over the next couple of years, even if it's not a straight line up.
Yields on Friday up. Yields this morning higher, up by 8 basis points on a 2-year, just short of 4% right now at 3.99. Kathy, given the conversation that we're all having at the moment, just how much upside is there at the front end of the curve?
Oh, I don't think there's a whole lot more. I mean, we've got the complication of the debt ceiling in there, so kind of boosting very short-term T-bill yields. But I don't think there's a lot more room on the upside, just because I agree that we're probably done with the rate hiking cycle. The question is, where does the intermediate long-term trend go from here? And we think that ultimately it goes lower because we do look for slowing in the economy, more downside in inflation, and an economy that may indeed tip into recession later this year.
So, Kathy, 10-year right now, let's call it 350. What are you looking for? 3? Down towards 2?
Yeah, we were looking, we've been forecasting 3 to 3.25% for year end. I think we're going to stick with that for the time being. Obviously, we've gotten down under 350 a little bit faster than we thought was going to happen, but we're going to stick with the 3 to 3.25 area. That gives you still room for inflation to run 2 to 2.5% and have some sort of risk premium over that for the 10-year.
CPI coming out on Wednesday, PPI coming out on Thursday. Later on this afternoon, we've been talking about this now for months, 2 p.m. Eastern time, we'll get the Fed's Senior Loan Officer Opinion Survey. The consensus is that credit conditions are tightening. We're about to find out, Mike McKee, by how much?
Yeah, it's kind of funny, John. If I had come to you with the Senior Loan Officer Survey 2 months ago, you would have heard this giant noise outside of all of Wall Street rolling their eyes. But today, it's very important. Are banks tightening credit even more? Well, you go back to January, the last time this survey was released, and they were tightening credit quite a bit. 43% said they had tightened somewhat. Only 1.5% said they'd tightened a lot. So maybe we watch the bottom line there. But is it really going to slow the economy? That's the question. Take a look at what's happened over the last month or so with all the problems we've had in banks, with the idea that banks are raising credit standards. And you can see that banks are still making loans. There was a kink when we had the crisis in the middle of March. But right now, loan growth is on its way up again. So will the Senior Loan Officer Survey tell us a whole lot? There were also concerns about whether people were pulling their money out of banks, and that would lead them to pull back. It doesn't look like it right now. We had a big drop in deposits after the bank issues in March, but now they have flattened out. So we're going to look at the Senior Loan Officer Survey, but we're probably going to have to keep an eye on the economy to really tell us whether or not banks are pulling back.
Comes out quarterly, of course, Mike, and for the first time, a lot of people will read this thing because many people don't need to, haven't needed to, so don't bother. Mike, when you open that up a little bit later on this afternoon, how would you say to people that they should look at it? What should they look for?
Well, you want to look at the overall numbers, probably. You can break it down by large or small in terms of how many are tightening credit standards by some amount, whether it's a lot or somewhat. And then you want to look at what loan demand is. Loan demand has fallen off somewhat. Is it really the banks tightening credit, or do businesses feel like they don't need credit at this point?
Mike McKee, thank you. Kathy Jones, I want to come to you on that. Mike McKee's been talking about this for a while. We all have May 8th. May 8th has arrived. We're going to get this data out a little bit later on this afternoon. We get weekly information from the Federal Reserve. We can get it from individual banks. We understand businesses from them individually about their access to credit at the moment. What is this going to tell us later on this afternoon that we don't know already?
Yeah, I think it's more a matter of degree. I think we do know that banks are tightening lending standards and that demand is down as the economy slows, and debt levels have moved up fairly significantly for small and medium-sized businesses. So I think that it's not going to tell us anything new. It's either going to confirm our prior expectations, or maybe it will not be quite as severe as the expectations are. But keep in mind, this is the first quarter, so a lot of the banking stress that we've seen has happened late in the first quarter and into April. So it may not totally reflect the current state of tightness in lending standards at the major banks, or the medium-sized banks in particular.
Brian Levitt, how useful is this later on this afternoon?
I think it is useful. I mean, we know how cycles play out. And even though this is a very bizarre, unique pandemic cycle, it's playing out the way all cycles play out, in that Fed raises rates to control inflation, growth slows, and the banks tighten lending standards. And as that's happening, spreads start to move out a bit. And so I think it is important. I agree that we already kind of sense this. We already kind of know it. But it's all about where are we going here, not the lag data. Where are we going forward? And I think it's pretty clear that banks are tightening lending standards, and the economy is going to slow here. But what everyone gets so concerned, is this the recession? What I also remind people is this is how new cycles play out. Right. So as the banks tighten lending standards, monetary policy shifts. That's when crises start to fade, and ultimately markets get ahead towards new cycles. So if you're tactical, you may want to be a little defensive in here. But again, and I said it before, over the next couple of years, we're setting up a good backdrop for markets.
Well, Brian, I think that's the difficulty on a tactical basis. You're hearing a lot of people trying to price the recovery to a recession we haven't had yet. They want the best of both worlds. They want to price in the rate cuts and all the good stuff. They want to avoid the bad data and look ahead to the better stuff.
Well,
this
that's
is
why
from
we're
Mike
range-bound.
Wilson. Mike Wilson this morning from Morgan Stanley. He's basically saying that the equity market continues to expect the best of both worlds, rate cuts and durable growth. We view the likelihood of both of those outcomes playing out in concert this year as low. Equities are priced for an optimistic and lower probability outcome. Brian, are equities priced for an optimistic and lower probability outcome?
Yeah, they're priced optimistically right now. I mean, the move that we saw in the beginning of the year was around the soft landing. We pulled back a little bit with some of the banking challenges and are now starting to move. We've been kind of range bound more recently. I think that we are going to retrace some of these recent gains as the economy rolls over. That's what history suggests. The question is, how bearish do you want to be? There's some strategist out there, and I don't want to misquote Mike Wilson, but I believe thinks that the bottom isn't in. We're going to go further down, and that would necessitate a pretty significant deterioration in earnings, plus inflation and rates staying elevated, so you get no multiple expansion. My opinion, we are going to see earnings moderate, but as interest rates come down, you'll start to see multiples expand. So I hate to be the on the one hand, on the other hand strategist that Harry Truman didn't want, but it is possible we retrace a bit. How worried are you about the next, call it 5-10% move versus not trying to not miss out on the recovery, which is going to play out over the next couple of years?
Brian, you're going to stick with us alongside Kathy Jones, looking at an equity market right now, about 20 minutes out from the opening bound, positive 0.1%. If you want one single name, we can pick out PacWest. Last Monday, double-digit name, $10 stock. Throughout last week, got absolutely pummeled, hammered. It was pretty brutal at times. We got to as low as around 250 on that name. We're back to about 760 this morning, going into the opening bound. Let's get you some movers. Here's Abby.
It's simply wild trading on that PacWest, John. And let's take a look at those shares, because after that big rally on Friday, the best day ever going back to 2000, up 82%. But within the worst week since March, just a piece of that volatility, up another 30% today. The company is cutting their dividend to a penny to accelerate capital build plans. I would say, though, a big piece of this bank turmoil, crisis in confidence. So right now we have confidence restored, at least for a second day. Tesla up 1.8%. The company is breaking ground on a lithium refining plant in Texas. Plus, Warren Buffett has praised Elon Musk, saying he's a brilliant guy. Those shares seem to be responding to the upside. And then finally, American Airlines upgraded to an overweight from a neutral over at JP Morgan. Shares up 3.5%. The analysts over at JP Morgan saying that Big Air has bested the discount airlines such as Southwest Airlines and Frontier Group. Both of those stocks are lower, but American Airlines, again, up 3.5%, John.
Abby, thank you. We'll get you a little bit more on that call around the opening bound. Look out for that. Futures right now up by a little more than 0.1%. Coming up, the debt ceiling debate coming to a head.
These negotiations should not take place with a gun really to the head of the American people.
The U.S. Treasury Secretary has a simple message for Congress. That conversation up next.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. it enabled them to really utilize the vehicle that's different.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
These negotiations should not take place with a gun really to the head of the American people. It's Congress's job to do this. If they fail to do it, we will have an economic and financial catastrophe that will be of our own making. And there is no action that President Biden and the U.S. Treasury can take to prevent that catastrophe.
Congress needs to do its job. That's the message from Secretary Yellen. The pressure to raise the debt limit mounting as President Biden prepares to sit down with congressional leaders Tuesday. This as the political divide intensifies on Capitol Hill. Senate Republicans doubling down on their agenda. More than 40 lawmakers telling Majority Leader Chuck Schumer, quote, this trajectory must be addressed with fiscal reform. For more, let's get to Bloomberg's Anne-Marie. Down at the White House, Anne-Marie, the latest, please.
Well, Jonathan, tomorrow is going to be a very highly anticipated meeting, and just because of what you're learning from there, the battle lines have been hardened, and what we have now is the majority of Republican senators saying there cannot be a no-strings-attached debt limit rise. There has to be fiscal and spending cuts attached to that, and this is something the White House does not want to see. They want to be able to get through Congress a clean debt ceiling rise. The issue they have is that they don't have the votes in Congress. So even when you have the Treasury Secretary coming out, warning about the X date being just around the corner, less than a month away, and saying that the Republicans have a gun to the economy's head, at the end of the day, at some point, there would likely need to be a negotiation. And that is why everyone is looking at tomorrow's meeting. Biden will be sitting down with congressional leadership, most notably Speaker McCarthy.
The issue that we all have is that what we're seeing, what we're witnessing, is a lot of political maneuvering going into the election next year. So let's talk about that. You get one of these every now and then. The president not exactly riding high. A bruising poll from ABC Washington Post, that poll released over the weekend. The percentage of those approving of Biden's performance has fallen to 36%, 6 points lower than in February, a point off his previous low in early 22. The detail here, AMH, 56% disapproved of his performance. 68% regarded Biden at 80 as too old for another term, and he does not have the lead over the former president, Donald Trump.
That's certainly what's in the poll, Jonathan, from ABC, Washington Post. It is a bruising one of you called it, a career low in terms of his approval rating. When it comes to the economy, they think the former president did a better job. And then, of course, his age. This is something that continues to haunt this president. He tried to make a joke about it. You were there with me at the White House Correspondents' Dinner saying they say I'm too old, I say I'm wise. But this is obviously something that is going to continue to dog him throughout this race. What is notable in this poll, very different from some of the others we've seen, is that he is lagging former President Donald Trump if there were to be a 2024 rematch of these two individuals. And the numbers here, Jonathan, are quite stark. When asked who they support in 2024, 44% said they would definitely or probably vote for Trump. More than the 38% who say they're willing to give Biden another 4 years.
Just amazing. AMH, thank you. Amazing that we face the prospect of round two of this face-off between these two individuals, and we're talking about this one issue out loud: age and mental acuity. This is what they said about age in this poll. 68% regarded Biden at 80 as too old for another term. For Trump, 44% viewed Trump, who's 76, as too advanced in years. Participants also rated Trump's physical health and mental acuity as higher. We're going to do this for the next 18 months. Kathy Jones and Brian Levitt, nervous that I might ask them about this. I'm not going to. Kathy, I'm going to talk about the debt limit with you. Kathy, when it comes to the debt limit, I just wonder where you can get an edge, where you can get a read on a subject like this one on Wall Street.
Yeah, it's difficult. We have a great team in Washington at Schwab. Keeps us up to date on the various goings on the Hill. And what they're telling us is that there's no easy out here for either side. So my colleague Mike Townsend has pointed out that there are 16 Republicans in Congress who have never voted to increase the debt ceiling, ever under any circumstances. So given how close this is, probably the best sort of outcome we can expect is a kick the can down the road towards the fall when the budget negotiations begin. And that's just going to mean more fiscal tightening ahead of us, most likely. So I think the only way we can play this is to stand back, be careful, particularly at the short end of the yield curve in case there's a technical default, but also anticipate tighter fiscal policy down the road, which kind of reinforces our view that the economy will continue to soften into the end of the year.
Brian, given this near-term risk, why wouldn't I just sell in May and run away?
Well, historically, selling in May and running away has not worked for investors. If you look at it long term, you've been far better off investing for the long term rather than trying to get out and get back in every November. Look, the last time we did this was in 2011, and the market did fall. The S&P 500 fell 17% from July through September as we were grappling with it. Now, that represented a very good buying opportunity in what was the early days of a news cycle. It was short-lived, and ultimately, like Churchill said, Americans did the right thing, but only after exhausting all other options. I find it very difficult to try and structure a portfolio around geopolitical risk or political risk, because as soon as you think you have a reasonable understanding of how it's going to play out, the opposite tends to happen. So I wouldn't want to try and get too cute around timing my portfolio based on the whims of a handful of politicians in Washington.
And Kathy, do you think that some of these companies are trying to time some debt issuance here? I'm thinking of Apple earlier this morning, 5-part offering, $5 billion deal, expected to price a little bit later. I understand from the team here at Bloomberg we could get anywhere from $30 billion to $35 billion of high-grade bond issuance this week. Do you think, Kathy, there's a window here to issue some debt ahead of what potentially might be a mess later on in the summer?
Yeah, I think that that's probably what a lot of corporate treasurers are thinking about right now, that they've got a little bit of time before this becomes even more tumultuous and potential sell-off in risk assets if we do get down to the wire or we have some sort of technical default. If I were in their shoes, I'd probably be doing the same thing. Yields are still pretty attractive, and they can do some financing now and stay away from all the volatility that could be ahead of us.
Kathy, it's so bizarre, isn't it? This is not about ability to pay. We've got the money in America. It's about, suppose, willingness, whether they'd actually come to an agreement and deliver the goods.
Yeah, it's a replay of 2011 in that way. And we saw in 2011, the oddity was that ultimately, when we had that moment when we had the downgrade, long-term treasuries rallied. And I think that the market knows that the U.S. can pay the bills. It is the downgrade was about the unwillingness to pay the bills. And so in 2011, what we saw was the expectation that we would get a weaker economy, lower inflation, all that turmoil, and people ran to long-term treasuries. It wouldn't surprise me if that happened again. Again, you would like to think that maybe something can be worked out in Washington before we get to this kind of moment where we get another downgrade. But 2011 teaches us that anything is possible.
Is it different this time? Kathy Jones, Brian Levitt, to the two of you, thank you. Coming up on this program, the morning calls, and later, there's no alternative to tech. That's the view from Citi's Stuart Kaiser. Why he's staying long the sector. We'll catch up with him around the opening bell. Equity futures right now, positive 0.1%. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
5 minutes out from the first opening bell of the week. Equity futures up by about 0.1%. Let's get you some morning calls. First up, Stifel. Downgrading Workday to hold. $200 price target, expecting limited upside with recent checks pointing to lackluster bookings. BMO upgrading Peloton to market perform, seeing a favourable risk reward with concerns now priced international exposure instead. That stock, $29.50 in the pre-market. Coming up, Citigroup's Stuart Kaiser making a case for more big tech outperformance. That conversation up next, your opening bell, just around the corner.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
23 seconds away from the opening bell. Let's get your trading week started. Equity futures right now positive just by 0.1% on the Nasdaq 100. Just a little softer, lighter, lower, negative here by 0.15%. Also, going into a key week on Wednesday, CPI, the day after that, PPI. There's your opening bell. Switch on the board and get to the bond market. Going into that, yields are higher by 7 basis points. 351 on a 10-year. A little bit later on this afternoon, 2 p.m. Eastern Time, the Senior Loan Officer Opinion Survey, much anticipated. Look out for that. Mike McKee is going to break that down for you later on this afternoon. In the FX market, the euro 110.38, positive 0.2%. To the euro's favour, euro stronger, dollar just a touch weaker, and crude higher by more than 3 percentage points, $73 and about 60 cents right now. About 20 seconds into the session, let's get you some scores. On the S&P 500, we are positive 0.1%. On the Nasdaq, we are going nowhere. One sector to watch at the open, the regionals. Pac West leading the rebound after slashing its quarterly dividend. The CEO saying this: reducing the dividend was a prudent step to accelerate our plans to build capital. Our business remains fundamentally sound. Shanali has more. Hey, Shanali.
Hey, John, when we look at Pac West, remember, we're looking at a bank that sold off by more than 40% last week alone amid the fears in the regional banking system. Now, listen, usually when a bank cuts its dividends, that is seen as a negative for the market. In this instance, you're seeing that big jump back after that massive sell-off last week in the vein that they are looking to preserve capital. Now, remember, we have also reported that PacWest in particular has been considering strategic options. There was another bit of negative news that came out late last week. This is idea that Fitch has placed it on a negative watch, and that is in part because of those strategic options. This idea here about the uncertainty about the strategic direction of a bank. Up till this point, we have talked about the pressure on net interest income. We have talked about the pressure on deposit flows in the banking system, and now the market is turning its attention to these bigger problems about what is a regional bank and is this business model sustainable. That is front and center with this Fitch notice on PacWest. But again, this is a bit of relief here. We know that when it comes to the idea of short selling, still allowed in these markets. We are waiting to see what the SEC has to say about this sector as a whole, as even though you're seeing a green day, a lot of the worries under the surface persist. Remember, one last thing here, John, we are turning attention not just to commercial real estate, but other types of loans like auto as well, keeping a close eye under the surface.
Shanali, thank you. Some of these names trading like penny stocks. Let's just leave that board up. PacWest at 750. Bear in mind, last Monday, it opened up at 1014. By the time we got to Thursday, intraday, the low was 248. Back in Europe, when we used to cover the Eurozone debt crisis, Greek banks, the price of them got so low, you just stopped quoting the percentage point move. The 745 is a 29% move this morning, which is about $1.60 higher on that name. We'll pick up on that story later. Let's turn to the airlines. President Biden expected to unveil new efforts to benefit stranded travelers. That's coming up at 1:45 Eastern Time. Katie Lyons has more. Hey, Kaylee.
Hey, John. Yeah, President Biden will be speaking alongside Secretary of Transportation Pete Buttigieg at the White House. And what they are expected to unveil is new rules that would mandate that airlines provide meals, hotels, and additional compensation for travelers on severely delayed or canceled flights. It also, we understand, would force airlines to improve the availability of customer service during periods of widespread delays or cancellations. I know probably all of us have experienced that kind of headache, John. This also, according to Bloomberg's reporting, will include a revamp of flightrights.gov. That is the Department of Transportation website that basically shows what airlines have what compensation-related policies. That was initially unveiled, rolled out last year, and as a result, many airlines did then explicitly state what their policies were. So there is a question of how much actually laying out full regulation will make a difference when some airlines have already taken action on their own. But according to officials at the White House, what they hope is that airlines will expand their policies beyond just refunds that customers are given in these kind of scenarios. Interesting, though, John, you don't necessarily see too much of a share reaction to the downside as a result of the idea of more regulation and having to pay out more to some customers. Largely airline stocks on the upswing today. Southwest, one exception. It's down just a few tenths of 1%.
Kelly, thanks for that. Let's stay there. Southwest is negative 0.3%. American is up by 3.5%. Here's a why. JP Morgan downgrading Southwest, upgrading American. The analyst saying this: the long-term relationship between discounters and the big three has inverted. It's now the larger airlines that control the high ground. Simply put, shares of American are too attractive to ignore, particularly during a time of significant international demand growth. American right now, about 4 minutes into the session, is higher by about 3%. Want to get to the earnings. This from Tyson Foods, recording its biggest drop in over 3 years after cutting its full-year sales forecast. The CEO saying, quote, a challenging market as consumers switch to cheaper goods. Katie Greifeld, that does not look good over there, does it?
No, not at all for the biggest American meat company. Cattle prices are at a record. We know that the cost of animal feed is rising as well. And like the CEO said, you have consumers trading down to cheaper foods. You add it all together, and that is hitting Tyson's bottom line in a big way. The company now sees revenue between $53 and $54 billion this year. Previously, that forecast had been between $55 and $57 billion. So that explains the big drop in shares today, down about 13% at the moment. That is the biggest drop since March 2020. Not a superlative you love to see. But let's get specific on that trade down, because you had beef sales decline about 2.9%, pork prices dropping by more than 10%. The good news, if there is good news, is that poultry sales actually climbed a little bit. And we know that Tyson is trying to beef up, if you will, its chicken segment. It said in March that it's going to close 2 of its underperforming poultry operations. So we'll see how that plays out.
Katie, thank you. No one wants a reference to 2020. Not many good things happened in spring 2020. The biggest one-day drop there since that period on Tyson, potentially. We're down by about 13%. In tech, Apple tapping the debt markets. Bloomberg learning the company is set to kick off a 5-part corporate bond sale that could lift issuance by more than $5 billion. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. $5 billion, you said, in as many as 5 parts, according to our Bloomberg source. It's interesting because the longest portion of the deal, a 30-year bond, could yield around 135 basis points over comparable treasuries, according to that source. The timing is kind of interesting. I think we have as many as 15 issuers looking at the market this Monday. We get CPI Wednesday, PPI Thursday, trying to get some stuff done, probably before that data print later on in the week. The way to look at it is this a sign of the corporate debt market stabilizing somewhat? Apple is not the first mega cap to go and tap the market. Last week, Meta sold about $8.5 billion in what was only its second ever bond sale. The other thing for Apple is that this would be the first bond sale since August, when they sold around $5.5 billion to fund share buybacks and dividend payments. And I think the expectation from Apple's perspective is that this year we could meet or exceed around $100 billion in shareholder returns. And Bloomberg source saying that this new sale could fund that, along with sort of general corporate purposes, CapEx, working capital. But yeah, interesting timing given the data that I know is coming later this week, John.
I was looking at use of proceeds, and it was basically just everything listed there, including capital returns. Ed, thank you for that, mate. There is a sense, there is a window here ahead of the debt ceiling mess to issue debt. 30 to 35 billion of U.S. high-grade bond issuance expected this week, according to the team here at Bloomberg. Kathy Jones of Schwab saying just that. Maybe this is some companies trying to get out ahead of all of that. Sticking with tech, Citi Stuart Kaiser staying long the sector, saying this: the tech thesis is less clean than to start the year, but we don't see a compelling sector alternative at this point. Stuart Kaiser joins us right now. Stuart, are we saying Tina's still a thing? There is no alternative to this?
Hey, Jonathan, good morning. Look, I think from a tech perspective, yeah, it's you're in a situation where short valuation is pushed higher, and we've definitely seen significant flows come into the space. But we do think there's still room for long-only investors in particular to add to exposure. And you've highlighted a lot of risks this morning around growth, around credit, around sentiment. And and if that's the case, we do think the tech sector is a good place to kind of be in that situation. So yeah, we're still on the sector, but would acknowledge that things have obviously changed quite a bit year to date.
Stuart, I always wait there. Sunday afternoon, I'm logged onto the Bloomberg, I'm doing my work for the week ahead, and your note always drops right there, right on cue. And your note this week started off with this, and I thought it was interesting. Markets were risk off for the week, but we are very surprised by the rally on payrolls. Investors seem happier about not bad growth data than concerned about hawkish wages. Now, Stuart, is good news simply good news at the moment, and how sustainable is that?
Yeah, look, I think particularly right around, when we started to get the regional bank stress, people started to really worry about recession risks and a pullback in credit. And I think what that did is it probably put growth, as priority number one over inflation for a period of time. And that's clearly what traded on Friday, right? Which was, a strong payrolls number, though with negative revisions, and a very, very hot wage number. But the market seemed to really embrace the payroll side of it. we didn't see this kind of short-term rapid deterioration in economic growth data that people had feared, and for that reason, the market moved higher. I'd also say, and we mentioned in the same note, is that you had a tremendous amount of really kind of tail risk kind of hedging in the system. So I think there were some people that were maybe, clenching their teeth a little bit about a big downward surprise. And when that didn't materialize, a lot of that positioning probably got cleaned up a little bit on Friday.
There seems to be some belief as well that we can enjoy this data without the threat of higher interest rates. From your perspective, Stuart, in your opinion, just how high is the hurdle to another hike of the Fed?
Look, I mean, they said they're data dependent. So, as you talked to Andrew Holenhorst on our econ team, and we do expect a hike in June. So, in our view, it's possible, it's in play, and it's largely going to be determined by the data as it comes in. And that's why we were so surprised on Friday. That was the hottest wage print we've seen since March of 2022. Certainly going to get the Fed's attention. Inflation, we have 2 more inflation prints and another job print before the FOMC. So, to me, June is kind of still in play. I know the markets aren't pricing that, so it's data dependent, and that means to me, you could get higher yields in June.
I just want to pick up on the market pricing right now. PacWest is fading. That stock was positive. It was through and approaching about 750. The stock coming just short of that, in and around that in today's session. It's pulled back to about 683. Not many people are constructive on this sector right now, Stuart, so I wasn't surprised to see the word cautious in your note on some of these banks, but you said cautious until private capital buys assets without a federal backstop. Stuart, can you talk me through just how you're thinking about this sector at the moment?
Yeah, look, John, it's a large and hugely complex issue. So we've really just tried to simplify it down, and that's until we see private investors willing to put cash into the space without, a federal backstop or the FDIC absorbing losses, then we're going to remain cautious, because what that's telling us is that institutional money does not see value in that space right now. And if they don't see value in the space, I don't understand enough about it to get involved. So, I mean, if you look at the deals that have happened, whether that's, in Europe or the 3 in the U.S. so far, the FDIC has written an 11-figure check in most cases to support those deals. And from my perspective as an individual investor, I just don't think you could put your money to work in that space while that's ongoing.
Stuart, it's amazing to see the S&P financials on the S&P 500 sit right on top of that 2007 peak. That means it's basically 16 years with no returns from that peak point to point, from then to now. Stuart, do you think that maybe after the bust of the last 12 months in big tech, that maybe we might be saying the same thing at the index level on the S&P 500 in 10 years' time?
You mean an extended period of sort of flattish returns?
Yeah.
Look, I mean, anything's possible, Jonathan, but I guess my pushback there would be, the equity markets have worked in higher inflation and higher rates, environments historically. And really what the markets want is some form of clarity. So, I think if we have some clarity on the rates outlook, some clarity on the inflation outlook, even if it's at a level that the Fed doesn't love, that equity markets can still work in that environment. And remember, the S&P 500 is a dynamically rebalanced portfolio, right? That's constantly increasing the weight of the highest ROE businesses in the world. So, I don't see why we'd be sort of dead money for a 10-year period. Realized valuation is a little high, and I realize there's a lot of challenges out there right now. But, I think if you step back, big picture, if you were to get rates volatility down, get some clarity on the inflation outlook, I still think equities can work. Risk reward obviously isn't great, and when you can get 5% yield in cash, obviously that's a high bar to get you back into equities. But no, I mean, I don't think we're calling for a 10-year period of dead money at this point.
Stuart, thanks for indulging me. Sometimes it's hard enough to get past next week, so why not look through the next decade? Stuart Kaiser there at Citi. Stuart, appreciate it, sir, as always. On the S&P 500, about 13 minutes into the session, we are positive by just 0.02%. Some of these gains out there fading at the moment. Coming up, the regional banks trying to rebound.
The information that we have at this point is the situation remains under control. The president is certainly looking at the options on the table.
A conversation up next.
happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The information that we have at this point is that the situation remains under control. I think there are indications that we are in a better place, certainly, and we continue to watch the situation as it unfolds. The president is certainly looking at the options on the table.
I can say the administration is going to closely monitor the market developments, including the short selling pressures on healthy banks.
It's quite literally my favorite phrase in Washington, D.C. We are closely monitoring markets. I still have absolutely no idea what that means. The regional banks this morning trying to stage a comeback. PacWest leading those names higher. This is Mohammed Al-Erin of Queen's College, Cambridge, warns there may be another leg to this story.
Now we have stage 2 where banks that are not particularly badly managed, they have issues, but they're not particularly badly managed, are suddenly vulnerable. And they're vulnerable to this path dependency, this multiple equilibrium.
Let's bring in the team. Kelly Lyons back with us alongside Shonali Vasa. Kelly, these gains on PacWest fading just a little bit.
Yeah, this is a stock that opened 30% higher on the day, now up just about 20%. And I say just, John, still objectively a really big move, but relatively when we look at the moves on this stock we have seen of late, it may actually seem quite small because remember, this is a stock that is coming off of an 80% gain from Friday. Even with the gains, though, over this session and last, is still a stock that is down 70% so far this year. So we still have a long way to go to undo that damage. Now, it's interesting to see the move this morning, despite the fact that the bank said it is going to slash its dividend. Analysts don't seem too surprised by that move, actually saying that it makes sense considering the bank wants to focus on capital building and the pace of that. So investors really seem to be taking it in stride as well. It raises a question, though, of whether or not we really have seen the worst of the selling pressure for both PacWest and some of its peers like Western Alliance, Zions, Comerica, others that have gotten caught up really in just this negative sentiment around regional banks. There was a question at the end of last week if that selling pressure had been overdone, if really what we were seeing in terms of the price action matched what was happening with bank fundamentals. And we also are still awaiting potentially more positive catalysts in the future. Morgan Stanley in a note this morning talking about the idea of potential changes to FDIC deposit insurance. Of course, John, that is something that would require congressional buy-in. And for that reason, we'll be looking ahead to the Senate Banking Committee hearing with regulators that's scheduled for next Thursday.
And trying to stage a recovery here, trying to rebound on PacWest on many names on the regional banking index, which has been absolutely hammered since early March. For the broader market, about 20 minutes into this session, the S&P 500 rolling over, turning negative, down by 0.1%. Yields higher at the front end by 6 basis points. Let's call it 398 on a 2-year. Do we need a countdown clock, Sonali Basak, for the Senior Loan Officer Opinion Survey, which comes out in about 4 hours' time?
Listen, this is a slow bleed. Remember, John, we have seen tightening standards for a number of quarters now. You really have to go back to the beginning of last year when you saw any easy and unchanged data when you looked at the loan officer surveys here. That was when banks were trying to capitalize on higher net interest income on the heels of rising interest rates. Now, there's some other interesting data that has come out on the heels of this report to take a look at to complement, really, the report that we're going to hear today. Goldman Sachs, for example, now reporting that 77% of respondents of their small business survey say that they're facing a credit crunch. And that is such a hard turn from a year ago when 77% were confident in their ability to access capital. So hard turn there. I think this is the ability to turn on a dime when we're watching the loan market here. I also like the special questions. Frankly, last time the banks were asked about the lending standards, they not only said almost every type of loan was being tightened here in terms of the standards, but they also expected almost every type of loan type to deteriorate in quality. We saw that from the January survey. Are we going to see some very kind of negative tones here when we look at the commentary from the loan officers?
Credit crunch, you said it, Sonali. Torsten Slok said it too over at Apollo. Torsten Slok over the weekend saying that these regionals face difficult issues, higher funding costs, lower asset prices, more regulation. Sonali, just how hard is it going to get for some of these banks once they get through the storm?
Yeah, look at the immediate storm that we're seeing here. You see it in the intraday volatility here of all of these stocks to begin with. But then again, I think the problem here is when you look at it, the horizon, that horizon just keeps getting further and further, John, when you think about the banking models that these firms have to contest to the point that Citigroup was making a little earlier, Stuart Kaiser, private capital is going to play a key role in this. You saw them step up with PacWest to some degree, but only with a form of collateralized loans here that they could feel safe with. We have not seen a wholesale shift into the private capital markets stepping up. So where does the funding come from if depositors are so flighty? And what is the business model even past this initial storm?
Sonali, thank you. 693 right now on PacWest. Sonali Basak there. Kelly Nines, thank you very much. For the broader market, about 22 minutes into the session, your equity market on the S&P slightly negative. We're down by about 0.1% with a sector price action. Here's Abby.
John, well, today's small decline, this move to the downside, at least right now, it has everything to do with big tech sliding. Let's take a look at the S&P 500 IMAP. We will see tech as the worst sector, down about 0.5%. It's the sector's big weighting to the index that's really creating a problem. Microsoft, Apple, NVIDIA, Amazon, Meta, Broadcom, these stocks are all lower. Consumer discretionary also lower, and that includes Amazon, of course. To the upside, though, is one that we have not seen all that much in recent weeks. Energy up 1.4%. This as oil is climbing higher again at $73 per barrel. In fact, over the last 2 days, we have energy higher, up 4.1%, even as oil up till today had been sliding for multiple weeks. John, a little bit of a reprieve for the energy sector.
Abby, thanks for that as we kick off the trading week. Looking ahead to some inflation data later on this week. Your trading diary up next.
of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Minutes into the session, just turning a little bit lower on the S&P 500, softer here, negative by 0.1%. That's the price action. Let's get to the trading diary. The highlights of the week ahead. President Biden speaking on the airlines at 1:45 Eastern Time. The highly anticipated senior loan officer survey at 2 p.m. later on this afternoon. The main financial stability report coming later as well, and Minneapolis Fed President Neil Kashkari discussing wages too. Tomorrow, it's the president's debt limit meeting with congressional leaders, the US CPI report out on Wednesday, and finally, PPI and another round of jobless claims on Thursday from New York City. That does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make a decision.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do.